Doom afternoon, everybody, and welcome back to DNN, the Doomers News Network, where we don't put a positive spin on financial news. We just call it how we see it because somebody has to. I am joined here today with Melody Wright and Travis from Real Estate Mindset. And with that, I'm going to turn it right over to Travis. How you doing today, brother?
I'm doing well, Jack. Thank you for that intro. Your intros are always the best, sir. Happy Saturday to all the viewers. And real quick, I'm just going to get in trouble right now, Jack, because I already know people are going to be like, Travis, you're not serious enough. You're goo goo gaga over Melody and Jack. And you know what? I love you guys. I appreciate the synergy. And you guys help make me better. So thank you. Absolutely humbled to be here. For the viewers, we have 6 stories for you today. The first story is going to be by our man, the radio voice himself, Melonhead Jack. Is going to talk about this week in Dune. Second story is going to be your housing market update. I'm going to go over the Redfin update. You guys know I did a report without even looking at Redfin. So now we have their report. We're going to see what that looks like. And then story number 3, I'm going to butcher this name, Melody. I'm sorry. She's like, Travis, don't mess up this name. And I already messed it up. It's going to be about the carry trade, the Japan and the yen and the unwinding. Right, Melody?
Yes.
Okay, I got that. Story number 4 is going to be by me and not Jack. I don't know why, but we're going to listen to Kathy Wood and the Stock Tales, what Kathy is actually saying about the stock market, which is a little bit more realistic than what she was saying in 2022 and 2023, which is just, in my opinion, full of over-optimism. So she's kind of coming down to earth. The 5th story is going to be Jack. He's going to talk about the Fed's dilemma, what's going on with the Federal Reserve right now. Really looking forward to that, Jack. And also really looking forward to our last story by Melody. It's going to be a little bit shorter, but it is definitely full of, man, just shocking. It's going to be about the critical drug shortage and the perverse profits that these people are making, based on deteriorating health of Americans and people around the world. So a lot of stuff to go over today. I'm going to pass this off now to Jack, who's going to go over this week in Dune.
Well, first of all, Travis, thank you so much for the wonderful comment about having a voice for radio. I'm also told that I have a face for radio as well. So thank you so much for those wonderful words. But enough about that. It's time for This Week in Doom. And it was a particularly doomy week this week, starting with peak doom on Monday morning. We woke up to absolute pandemonium in markets, thanks to something our very own Melody Wright has been all over for the last couple of weeks. The yen carry trade and the unwind of the yen carry trade caused absolute mayhem in markets Sunday night in Japan while we were sleeping, and then again Monday morning here in the U.S. What you're looking at here is the Nikkei 225. This is the Japanese big stock market index, kind of like their S&P 500. And it was down 12.5% on Monday morning, Sunday evening. Again, we're talking about Japan time. The worst single day in the Japanese stock market since Black Monday of 1987, almost 40 years ago. We also saw significant strengthening of the Japanese yen over that same time, with the Japanese yen going as low as 141.5 to the US dollar. Remember, when you see this chart of USD JPY heading lower, that's the yen strengthening. And you can see this all started on July 11th on the weaker than expected US CPI print, and then the Japanese Finance Ministry intervening in their Forex market. And of course, it steepened and then led to all-out panic on Monday as the carry trade unwound. Also, we had U.S. stocks were sent crashing on that news because part of the yen carry trade has been borrowing yen, converting to dollars, and buying risky U.S. tech stocks. So we had one of the worst days in years in the U.S. stock market. And in a shocking and totally not pre-planned and not at all suspicious turn of events, every brokerage company in the United States simultaneously went down due to some unforeseen technical difficulties, maintenance, third-party outage, whatever the cover story was. They all failed at the same time when everybody was trying to sell. Inconvenience for you poor people, but the banks and the big trading houses, they didn't have any trouble completing their trades. And I'm sure that's all just a silly coincidence, and one day we'll all look back on this and laugh. And then, of course, just a day later, we got Japan's deputy governor of their BOJ, Shinichi Uchida, and I'm sure I butchered that pronunciation. He came out and immediately pivoted dovish following the mayhem of Monday morning when he said the Bank of Japan will not raise interest rates when markets are unstable. basically telling the market, hey, chill out, guys. We're done with these rate hikes. If you guys are throwing a fit, we're not going to add to that problem, which was viewed as a very weak statement from the BOJ, and them immediately walking back their hawkish turn. And you could see that almost immediately in Japanese stocks. They began to recover and ended up closing the week almost back where they started. Most of those losses were recovered over the following couple of days. And we even saw the Japanese yen start to weaken again following those comments. So the BOJ blinked first in this game of chicken with markets. And of course, U.S. stocks would also recover on that news. And then we got further turmoil at artificial intelligence startup OpenAI, the big AI company that's out there run by Sam Altman, who's shown here in the top right. We had more senior executives leaving the company. This is a trend we've seen a lot in the last couple of days. Starting with the bottom left there, that's president and co-founder John Schulman. He announced he's leaving the company to go work at rival Anthropic, which is partially owned by Amazon and Google. Also, we had in the top left there, that's also co-founder Greg Brockman, who announced he's going on extended leave for the rest of the year. I don't know what that means. Is he going backpacking through Europe, going to go try to find himself on walkabout? Who knows? He's not going to work at the company for the rest of the year. And lastly, product manager Peter Deng, shown there in the bottom right, he has also quit the company. Out of 11 co-founders of OpenAI, now only 2 remain at the company, and one of them is on extended leave for the rest of the year. Sam Altman continues to drive away the senior team. Something is going on at OpenAI. What it is ain't exactly clear. And then we had some mayhem at the U.S. Treasury this week. It didn't get a lot of coverage in the press, but there was a 10-year Treasury auction on Wednesday and a 30-year Treasury auction on Thursday. And both Treasury auctions were very poorly received by the bond market. The auctions each saw more than 3 basis points worth of tail. And a tail is when the auction starts, you have an interest rate that was, the average interest rate received before the start of the auction. And then the government starts to lower the price of the bonds until enough bidders show up to buy everything that the government is selling. And as they lower the price, the interest rate is rising. And the difference in those interest rates between the beginning and the end of the auction is known as the tail. And just to put that in perspective, the average tail of a Treasury auction for the last 6 months has been about 0.1 basis points. And well, both of these auctions saw a 3 basis point tail, which means appetite for U.S. Treasury bonds was suddenly much lower, despite the panic on Monday morning when people were buying Treasury bonds hand over fist. I suspect that pivot from the Bank of Japan has bond traders starting to worry about long-term inflation expectations now, and they're starting to demand higher interest rates for tying up their money for 10, 20, or even 30 years. And then we got earnings on Friday morning from Taiwan Semiconductor, showing that monthly sales for the month of July rose by 45% year over year, being led almost exclusively by growth in chips needed for artificial intelligence. So this is leading many to suspect that NVIDIA is probably going to report another fantastic quarter on August 28th when they report. So a little bit of air may be left in that AI bubble still as people continue to order these big AI chips from Taiwan Semiconductor, who builds them. Then on Thursday, the market was celebrating because we got jobless claims in the United States, and the market has been very worried about unemployment since we got those jobs numbers on Friday that were a big disappointment. Recall, unemployment rose last Friday to 4.3% from 4.1%. So everybody was watching these weekly jobless claims numbers like a hawk on Thursday morning. And as you can see here on this chart, the initial jobless claims came in well below last week's number at 233,000. That is down a big amount from 250,000 last week, although still higher than the average we've seen over the last year or so, down a good amount from last week. The market interpreted that as a good news. And of course, continuing jobless claims continues to rise. We saw continuing jobless claims rise to 1.88 million. That's up from 1.87 million last week. So people continue to lose their jobs, although at a slightly slower rate than last week. But those people who have already lost their jobs are still having a harder time finding a new one. And so the continuing jobless claims continues to get higher. But this data was interpreted as slightly better than the data we got on Friday. And so stocks rallied on Thursday. And then we also got interesting this week. We had some very bad data about travel, in particular, theme parks, restaurants, hotels, and airlines all reporting lousy news this week, showing that people aren't traveling. We had Disney, Six Flags, and Universal Studios all reporting declining revenues at theme parks. And then accommodation stocks like Airbnb, which had their worst day ever when they reported earnings. And companies like Hilton and Expedia are also showing slower demand for hotels. Airlines have been struggling with lower fees because they all added capacity last year. And now there are fewer travelers. And so they're having to lower fares to fill up the planes. Airline stocks are way down. And even restaurants this week, we got earnings from companies like Dine Brands and Yum Brands, both of which reporting that consumers are strapped and trading down in restaurants, going for more budget alternatives. Guys, the takeaway from all of this is that the consumer is out of money. Americans could really use a vacation, but they are just not taking it. And lastly, we had VP Kamala Harris finally announced her chosen running mate for vice president. And it was none other than Minnesota Governor Tim Walz, which had the entire country stand up in unison and say, who? And that concludes This Week in Doom.
Travis, quickly, I just want to mention that in addition to the theme parks, we're hearing, and I got this hashtag from my friends at MacroEdge, that Burning Man also has not sold out. And that is the first time. And if you guys don't know what it is, it's a big, I don't even know what to call it, in the desert where all the techies go and do mushrooms and run around naked. That's a simplistic explanation, but it has been sold out. It's been something that, the must go to. Last year, everybody went and got stuck in the mud. But, this is, if you're anybody in tech, you're supposed to be at Burning Man. But apparently they have tickets left. That is unheard of. So yes, I think the consumer is dead.
Well, the Bulls told me otherwise, and CNN and Fox News, they said the consumer is good and the economy is good and that we should keep spending to the end. So I just don't buy it, Jack. Sorry, buddy.
Nope. Sorry. Doom doesn't lie.
Math does matter, huh, Jack?
Math matters indeed. Oh, indeed.
All right. And to the viewers, good morning to everyone. I see, we're getting some people come online. You guys don't forget to comment. We're going to address some of these comments and I will flash some of those comments on the screen. I'm going to get started now on my story, and my story is going to be about the housing market. And before I go into it, okay, I want to say this, and this is so important to understand when it comes to the housing market, when it comes to real estate. Every market is the same. We have massive macro pressures being put on home prices. I don't think that right now is a good time to purchase. I think overall it's very toxic and very, very dangerous. I think the whole industry is built on lies, corruption, and fraud. However, it's still, having said that, you guys got to understand, it is still so divided in the housing market, which means we can't really, sum up everything into one narrative. And also what that means is if you really want to understand what's going on with you and with your market, you have to do something called subdivision analysis. And I'm going to show you guys real quick what that looks like. All right. So let me throw my screen up here. Let me throw this on the screen. Boom. All right. So first of all, what I wanted to show the viewers is this right here. This is the MLS, or multiple listing service. You guys that have been watching me know that I've been screaming at the top of my lungs. This is what the public really needs access to. If the public had access to this data, I don't think there would be as much fraud, corruption, and heartbreak and buyer's remorse surveys and deceit and all these types of things. This is more raw data. This is data that I could really teach the public how to find wedge and cash flow. But my point here is, it's a mess. When I first accessed this market, this is a small little market. This is Kingwood. There's a whole bunch of data and people get lost when they look at this. All right. This is very confusing. I mean, my God, what is this? Now, first of all, the good thing is inventory has freaking exploded. So I have rates going down, incentives going up, price cuts, days on market. But the good thing, inventory is absolutely skyrocketing. But my point is what I'm hoping people will start learning is how to filter the data to find the deal, how to shut out the noise, right? We want to focus on ourselves. We want to focus on our own investment, and we want to block out all of this noise and yelling and fighting and cheerleading. And the way to do that is you got to go hyper local. You got to zoom in. Okay. You got to zoom in, and you have to understand that when you zoom in, it gets a lot more clear. It gets a lot easier to understand what's going on when you zoom in. when you go hyper local. And that's what this looks like. So if I wanted to buy a house in this subdivision, Kings Manor, then all I care about as a consumer is Kings Manor. Then I would do an analysis on Kings Manor right here, going back 5 years. I want to find a property that has 2019 prices, but when I'm comparing wedge and cash flow, I typically go to 2021. So usually I know in Kings Manor what the price per square foot is in 2021. I know in this subdivision what the price per square foot is in 2021. And so if you really want to tackle this, you do an analysis on each of these subdivisions. Okay. So this is subdivision here, here, and that way you don't have to be blinded by being overwhelmed with data. All right. And that's the point I want to make. So don't get overwhelmed with the data. Let me come back over here now. And what I'm going to try to do now is this. Okay. So I'm going to go into, let me switch right here. Actually, I want to put myself on the top. I'm going to go into a housing market report now. I'm going to take over the screen. And if you guys watched one of my housing market videos, I actually was able to do a video before Redfin came out with their housing market report. And I asked my viewers, Melody and Jack, to guess the title of the new Redfin article. I was like, I'm just going to give you guys the update without the article. And I was like, they're probably going to say something, mortgage rates drop, and a little bit of home buyer demand came back. And I was 50-50 on them acknowledging the historical record price cuts. We have historical, and guess what? They did not include the historical record price cuts. Here it is right here, you guys. I'm going to take over now. And I was pretty much accurate. Look at the title. Mortgage rates dropped to the lowest level. Okay, there it is right there in over a year, prompting some, okay, right, a little bit of demand, some house hunters to ramp up touring. Now, I'm going to make our way through this. I've crossed out all of these paragraphs here because it's completely useless to listen to these frauds. And this is just my opinion, you guys. This is my opinion. They're frauds, and they can't even do simple math. When it comes to Redfin, 2 + 2 = 197. Okay, so I've just crossed this out. But what I do want to point out is the fear of missing out will always be there with realtors and data providers. They will always, doesn't matter what the market is doing, they're always going to try to get you to buy. And I just wanted to point out their most recent fear of missing out statement from their realtor. So this is what the realtors are saying. Many of the buyers I'm working with are excited because they've been casually house hunting for a year. So they're not excited about the price drops. Come on, guys. I mean, what are they excited about? What are they excited about? I lost my place here. I'm so sorry. Who have been casually house hunting for a year, waiting for rates to come down before they make an offer. Again, rates. They're not looking at price. Now, a lot of those buyers want to get in now. And listen to this. This is the crazy thing. I hate this about the industry. Before rates get too low and cause more competition. So do you guys see my point? They're always pushing people in the market. You got to go now before they get too low. Like, congratulations, guys. Rates have gone down, but demand has not gone up. But you better get in right now because they're going to get lower. And eventually, at some point, demand will get up. But I need my commission today. I need my commission today. And that's how a lot of realtors do business, unfortunately. It does suck. I wanted to go over the leading indicators with you. And I wanted to talk about this narrative, which is when rates go down, we will have a flood of demand coming back in the market. Now, I'm going to tell you guys, when rates go down, depending on what they go down to and depending on the reason why, it will cause some demand to come back. Some demand will come back. What we need to understand is what's going to come back more, supply and inventory or demand. And so far, demand is gone. Demand is gone, guys. And this is my proof right here. So we have year over year and week over week comparisons now. Rates are down year over year. Rates are also down week over week. And yet we still have triple digit decline in demand. So we have rates going down, but again, 11% down with applications, 13% down on their own proprietary data as far as demand. And last but not least, searches online. Now this is up week over week, but it's still down 15% year over year. And that's why I'm saying I want to acknowledge, yes, there will be some demand that comes back into the market, but not a lot. At least that's what we're seeing so far. So moving on, you guys, this is beautiful. Now, don't forget, we've been tracking this from day one. We were notified July 14th. That's why I had everyone remember July 14th, because on July 14th, we were notified that July 7th, was the start of this year's price decline. And my question to everyone was, will seasonality come back February of 2025? I don't even care necessarily what happens in the next 6 months. I want everyone to know beyond a shadow of doubt that we are in the housing market collapse, and that February in 2025 seasonality will not sustain prices on a nationwide average. And so far, you guys, if we want to see nominal price decline, we have the pace we need. And by the way, it's going to be hard to get there, but we have the pace we need. In less than 1 month, in less than 30 days, we've dropped $6,300 on nationwide median, 4-week rolling median. Okay, in less than 1 month, $6,300. So, call it what you want. That is the data. Let's go on. All right, let's look at this week's winners and losers. And I'm trolling Melody here. Okay, Melody, I'm trolling you. And it's not, my doctor handwriting. I'm trolling Melody because Melody and I have this whole little like rivalry. So, rivalry thing going on here where I'm like, Texas is in worse shape than Florida. And she's like, no, Florida's in worse shape than Texas. And this is a losing, this is kind of a losing thing. So it's not really cool. But so far, Texas is spanking Florida as far as the meltdown in prices and inventory, but Florida is catching up. And I wanted to point out that we finally, in Troy, are you watching? Is Trey? Raymond, where's Trey at? Trey, you watching, buddy? Nashville, Tennessee is down year over year, buddy. Congratulations. Houston is in the lead. I hope so. But anyways, guys, we have Florida on the list, and now we have Tennessee on the list. But obviously leading is Austin, Dallas, San Antonio. I'm a little bit surprised that Fort Worth is not in here. But nevertheless, guys, it's still about subdivision review. And now take a look at the other side of the world. And this is why I say, all right, we got to stop being so polarizing. I know I had to learn this myself because there are still some markets, guys, that are super tight. So when we hear this narrative, oh, prices are only going up, that may be true in Detroit. That may be true in Anaheim. But again, when we look at the nationwide 4-week median rolling, it's not true. So I want to acknowledge there are some markets that are still tight, but it is changing. Now, some of the things, leading indicators I like to look at is pending sales, being that my town of Houston is down 30%, but I haven't seen like a massive decline in prices yet. Houston has massive migration. So that's why we have so much new home building. I mean, everywhere. It blows people's minds when they come to visit me. This is also very interesting. New listings. So I would suspect San Jose will start seeing some price decline because the inventory is absolutely exploding. And then the question is why? Why is it exploding? Anyways, getting to data vision, I'm trying to wrap this up. I'm sorry. So here we are right here, you guys. Again, since July 7th, okay, prices have been going down at a rate of over 6K. Okay, that's a month. It's actually faster. Now, here's the thing that I want you guys to know about this chart. 2 things. I'm saying we're going to have year-over-year price decline. If we have year-over-year price decline, all that needs to happen, guys, is this blue line needs to go under this orange line. That's it. That's all that happens. If that blue line goes under that orange line, we will have year-over-year price decline. But I'm more curious on how we're going to end. I don't care about these little petty little on and off the year-over-year price. I don't care about that. I care about the median 4-week going under 361. All right. So even if we go under that orange line throughout this year, I don't want to get stuck in that narrative. Like prices are crashing for other reasons, like income growth and things like that, and fear of missing out and fraud and corruption. But we need to get under 361. All right. And Melody and I believe, and I've actually been a little bit more aggressive than Melody. I'm saying 5 to 7 minimum. And in order to get that, we need this to get to 340. So we got some room to go, but what I am also saying is the trajectory is there. And I'm going to do one thing else, that red line. Okay. This is why I have such a gripe with these proprietary data centers and all of this fraud and corruption and price buckets with median. Remember, the red line went like this. Okay. I'm going to draw how the red line went before they revised it. Okay. So here's what happened in 2022 with home prices. All right. We peaked up here. All right, ahead of where we're at right now. And this is the trajectory. Okay, that's what happened in 2022. The gap in revisions is here. That's the gap. And the reason I'm telling you guys that is just remember when society and consumers start realizing it's not time to buy, topped with they just can't buy because they're overwhelmed in debt, things change real fast. Things change real fast. It may be slow like this, you see in 2021, but when things collapse, you guys, it collapses fast. when all is said and done, though, it's still up to you to buy a house. It's your commitment. Now take a look at this, and this is just so shocking. This is home buying housing payments. Now the thing here, guys, is we need one of three things or a combination of all three things to happen, which is more income, lower interest rates, and lower prices. Here's the thing, and this is what I'm saying, and I'm just going to be point blank here, okay, guys? Prices, okay? People are like, prices, they're going to sustain. That's what the bulls say, Melody, Jack. They say prices are going to sustain. This time is different. Fight the Fed because of supply and demand. That's been their whole debate pretty much this whole time. But what I have been saying is and Melody and Jack, people can't afford it. People can't afford it. And the thing, guys, is I'm bullish. People, I'm bullish. The problem is, and I'm saying specifically, home prices can only sustain if income growth somewhat matched it. If income growth somewhat matched this price growth, then I'd be like, all right, this thing's not crashing. But you guys, we never even had income growth, and the income growth that we had was not real. The price growth that we had was not real. It was unnatural. Do you guys remember what happened a few years ago? Do you remember the lockdowns? Do you remember that whole virus thing? That's why we have what we have. This is unnatural. So why are the bulls saying that this is natural? I don't get it. Anyways, moving on. Pending sales, 4-year low for this time of years. That is demand down. All right, here's new listings. I like this. I had Lance on the channel. Lance is a famous dude. He's a bit bullish. That's fine. He gets, I'm going to be respectful. All right. But anyways, we had a massive increase in new listings. Now, there's a few things that I think this could be. Number one, it could be seasonal. Okay. Because if you look here, we had a slight increase here and here as well. So we had a slight increase at that time frame. So I don't want to rule out seasonal, because we don't have enough trends, right? We need a trend here. So it may be seasonal, but we also may be seeing defaults. And we also may be seeing lower interest rates, which is the golden handcuff. But I do think it's interesting to note that interest rates went down and new listings shot up. That's interesting. Okay, but again, I'm not ready to make any conclusions, Melody. Jack, I'm not ready to make any conclusions until we have more data, because it is possible that is seasonal. But it is very interesting to look at. Now, here's active listings, 1 million. I'm going to put a star right there because I said back in December, we need 1 million, and then prices will go down. That was just my guesstimate. I know you guys hate guessing because we get roasted when we're wrong. And trust me, I have been wrong a handful of times. But 1 week after we hit 1 million, prices went down. We have sustained 1 million. This is good. I've been saying that, and we need it sustained. That's where we're at. Prices are going down because inventory is a leading indicator. Now, here's what's interesting. Here's supply. Supply is a measure between demand and inventory. Now, the opposite thing happened versus new listings. Okay, so new listings shot up and somehow supply went down, which would suggest that demand went up. That is the only way to explain that. So if demand went up, that would mean it's not yet reporting in the data. So I'm just letting everyone know I'll be watching this like a hawk because I'm very curious as to why we had that opposite effect right there. But this can also be seasonality, and it can also be interest rates as well, bringing back in some buyers. The reason I am pointing this out is you can trust us to confront any data. Any data we will go over with you guys, and that's what I've been thinking right there, right? So we'll watch that. Here's pending sales, 4-year low. Here is homes sold. DOM, we have a 4-year high as far as DOM. We're at 34 days. Anytime we're at 30, that is good if you want prices to go down. And that has been that way for a very long time. The housing market, you guys, is in really bad shape. 4-year low as far as home selling above their list price. 4-year low. How about that? Very interesting, the dynamics in the housing market. Also, remember I said 50-50. Redfin is going to put this in their title. They chose not to. Oh, well, we have a new all-time in the galactic history of the United States, far exceeding the birth of this galaxy. We have a new all-time record, 7.2%. The trajectory of price cuts right now are demonstrating to us that sellers need to sell and are desperate to sell and are starting to realize overall that the only way for them to sell is to reduce the price. And even that is not working. How do we know that's not working? Guys, how do we know that that's not working? Well, because demand is still at 4-year lows. with that data. And actually, demand is as low as in the 80s. If these things were working, demand wouldn't be in the 80s. Just saying. Let's keep going. I'm almost done. I'm not done roasting them yet. Okay. I want to roast a little bit more. The last roast is, I saved it for the end. Demand 4-year low. All right. So we have demand 4-year low. I'm going to do one more thing. Just one more thing here. I'm going to play you guys, and then I'm going to be done. What realtors were saying in 2008. Okay, so this is it's a little dicey. Maybe I shouldn't play this video, but I just wanted to play one more video because I just wanted us to ask the question is how much value are realtors giving back? And we can learn that because remember, you guys, in 2008, so I'm going to play you an ad from the National Association of Realtors from 2008. And in 2008, you guys, what happened? Everyone that bought in 2008 lost bad, and we're not everyone, but like a high percentage. So let's just remember, and if you guys can, let me know that the audio is okay here. Let's see what the realtors had to say in 2008, right as the market was collapsing. And then you guys tell me, are realtors doing a good job or not? Is the audio okay? I guess you should.
When it comes to buying a home, family conditions often outweigh market conditions. If you purchase one of the millions of homes that will be sold this year, the National Association of Realtors wants you to know that you're making a good move for your family and towards building long-term wealth. In fact, 60% of the average homeowner.
You know, they said 60% of the average homeowner, their wealth is built into their house, and that's normally right, but 100% of the people that listen to them lost their butt by taking their advice. And so I just wanted to end on, you got to be careful of that reckless optimism. Don't spend your money. That's how I would like to end. Any follow-ups on that, Jack, Melody?
National Association of People Who Work on Commission wants you to know it's a great time to buy. Yeah, that's awesome.
Right.
Great messaging there. Oh, you, Mel, go ahead.
Yeah, Travis, so I kind of have an open-ended question for you because I think that, the housing market is a very complicated ecosystem, and I'm going to go into a lot of that in my next story. But why is it, do you think, that people focus so on just home prices and don't want to think through what could be happening in a frozen market with home prices?
Because they're only looking at half the picture. The bulls are only keeping them at half the picture, which is prices never go down, and that's all they look at. And then they immediately go to payment. And so if everyone's sold on payment and rates are going down, then it allows the narrative to continue to be pushed. And the other problem, Melody, is the people at the very top that public would assume are there to protect them, like realtors. They're just a bunch of cheerleading scumbags that are just trying to push people into houses. No, not that NAR commercial ad in 2008 that I just played used the word family, right? What realtors are doing, unbeknownst to them, because they're trained by National Association of Realtors and then the brokers, they're trained to be cheerleaders, Melody. They're not trained to actually help people. They're not helping people. They're helping themselves, and they're helping that bottom line commission. If the real estate market wasn't full of a bunch, like Jack said, a bunch of commission-hungry losers, I don't think we would be even near the catastrophe that we're in now. And the other problem is the public assumes they can trust.
Okay, follow up. My follow-up question is, okay, so, but there's something else driving that, right? I mean, we all don't why are those realtors out there pushing this narrative? Like, what is the incentive for NAR and other folks? I mean, what is it that we're trying to accomplish by pushing that narrative?
The bottom line, if they convince people to buy, they will make money. They have to. Their entire existence, Melody, depends on selling houses. And so they can only talk about optimistic stuff. I mean, and they're very good at it. They're very good at using BS to sound good, right? I mean, they sound like an encyclopedia, but they're wrong. I've never heard people that are so wrong sound so right in my life.
Jack, do you want to take it?
Yeah, it's not so much a question, Trav, as just I'm going to soapbox for a minute. Forgive me here. But the headlines this week, especially when we got the mortgage application data midweek, biggest drop in mortgage rates in weeks, sends demands for mortgages surging, right? Again, all the positive spin. You always get this positive spin in Redfin, and Zillow, they're the worst. But even your mainstream, your CNBC and your Bloomberg, they do it too. But what actually happened with that mortgage application data? They said, oh my God, mortgage applications surged by 6.9%, the biggest surge in years. That was made up of a 16% surge in applications to refinance and a 1% surge in applications to buy. So it's not home buyers, it's people refinance that are taking advantage of these rates. And who's refinancing right now at interest rates that are 6.5% when they've probably got a 3 or a 4% mortgage already? It's people who are up to their eyeballs in credit card debt, who are consolidating higher interest debt and doing a cash out refi. So that mortgage application data, once you start actually reading beyond the headlines and parsing the data, you see there's a lot of hardship in there. It's all refis. It is not buyers. And the other thing you got to ask is, why are these interest rates dropping right now? The biggest drop in interest rates that happened, if using like the 10-year treasury as a guide, the biggest drop in interest rates during these last few weeks was last Friday. And what happened last Friday? We got that non-farm payrolls number that showed disappointing job growth and unemployment rising from 4.1 to 4.3%. So interest rates are lowering right now because there's a recession coming and traders are positioning for safety. Interest rates are not going down because it's a good time to buy a freaking house. People are losing a job. So that statement of like, oh, people are trying to get in and hurry up and buy a house before interest rates drop. Who said that? Was that the great financial guru, no one ever, who said that? Because nobody wants to buy a house before interest rates drop. That's one of the stupidest things I've ever heard. And the other reason interest rates are falling right now is because the Fed and the Treasury are both sending false market signals by adding fake liquidity to the long end of the yield curve. The Treasury is doing it with their Treasury buybacks, where they're selling more short-term debt and using the proceeds to retire cheaper long-term debt. They recently doubled the pace that they're doing that, from $15 billion a month to $30 billion a month. And even though the Federal Reserve has been doing quantitative tightening, they've actually been buying more long-term debt as they've been doing tightening, because they're retiring more short-term debt, but actually still adding to the 10, 20, and 30-year holdings. So both the Treasury and the central bank are sending false market signals through the long end of the yield curve to artificially lower interest rates, because politics probably. And that is sending false information to markets. That doesn't make it a good time to buy a house. That makes it a terrible time to buy a house. Interest rates are heading lower because there is mayhem on the horizon and bond traders can see it. End of soapbox.
And I will be going more into that in my story next as well. So Travis, anything else? Otherwise, I'd love for you to present my screen.
Yeah, just this last thing. I just to what Jack was saying, Melody, you know this full well. They're playing your emotion. They're not ours. Well, actually, they're trying to play ours. They're playing your all's emotions. The market's acting like a bunch of elementary school children. Think about it. The federal funds rate has changed zero. They have not even changed the federal funds rate, and the swing on the mortgage rates are 160 basis points, going from 8% to about 6.4%. That's all emotion. All of it is emotion.
Well, so I might have some contra points to what has just been said, but we shall get started. So in my Substack this week, this segment, we're going to be talking about the Japan carry trade. We're also going to be talking a lot about what Jack was just mentioning about these conflicting activities in the market with the Fed and the active Treasury issuance from the Treasury and how that's impacting the 10-year Treasury. But just to kind of launch off what both Jack and Travis said, the press went hog wild. That's a Southern saying about these rates that dropped. And to Jack's point, I didn't even go into the purchase side of it in my Substack this week, because that's not the activity. Rate drops are going to increase that refi activity. And I believe that is what our Treasury Secretary wants to do, is kind of get us to a certain interest rate where we will get that refi activity so people can extract their home equity at a time when you're seeing distress because of unemployment. And that would give people just enough room to make it through the election. But let's just kind of start with mortgage rates. Most people don't understand mortgage rates. They think the Fed has impacts on mortgage rates directly. So they indirectly do. But what people look at in the world actually is the 10-year Treasury rate. This is the borrowing rate for the entire world. And so when you're thinking about mortgages, you want to look at that 10-year treasury. Now, since 1971, the 10-year treasury to the mortgage rate has about a spread of 1.75%. And then that gets tighter in times when the Fed is buying those mortgage backed securities. And so this is really important for this story about how many refinances we would get if rates started to drop. And so I want to talk about that and try to slow it down, even for myself. And so the first thing that, I think all of us on this channel have kind of argued that we thought that, they would do everything in their power to sustain the markets at these levels until we got through the election. And I think that that has been happening. But we said on this show last week that sometimes the horse can get out of the barn. And I think that's what happened on Monday. And we'll discuss that in detail. But Nouriel Roubini accused Treasury Secretary Yellen of this active Treasury issuance, where just like Jack was saying, they were issuing a lot more short-term duration debt in the marketplace to try to control that long end of the curve, as well as in many ways, what Roubini argues is that this actually is like a quantitative easing. And because when the banks have to buy a 10-year, 30-year, they take on duration risk. And so, but when they only have to buy a short-term bill, it's basically just going right back into the system. And it doesn't change behavior of those participating. And so this is really important to understand because, and what I want to get across here is I don't expect everybody to understand this. I don't understand it all, but there are just so many forces and factors. And sometimes there's not just one person at the lever. These things just get out of control. And I think that's what happened. We're going to talk a little bit about what happened on Friday and Monday of this week. And so just know that Yellen is out there trying to essentially, or this is the accusation, and whether she is or she isn't doing it on purpose, it's absolutely having the same effect. It's the same thing that happened at the end of December, and it drove those rates down. And that's how we got that renewed activity in the spring in housing. What I think is really funny is that I think, just as Travis was saying, they thought that, oh, more home buying would occur. But actually what it did is it drove out the inventory as motivated sellers were like, oh, wow, okay, if the rates are lower, people might buy this albatross, my second, third home, or my fix and flip, and they're starting to list those properties. And so then I just kind of want to talk about Japan again, because guys, Japan is very critical to this story. They are, as we talked about here on this show, the largest holder of U.S. Treasury securities. And so what they do matters. And so there's been a great article written or a presentation recently by Russell Napier, who talks about how the Japanese are going to have to repatriate funds because of their incredible outstanding debt balance, which I will show you guys here really quickly. And then we'll kind of go back to talking about this supposed refi boom. So do I have a picture of their balance sheet? I do. Oh, here it is. Okay. So here is a slide from the Russell Napier presentation showing world non-financial debts GDP. And you can see Japan is number one on this. And so they are in trouble, just as most of us are in trouble from all of this debt and all of the debt service costs. But let's go back to talking a little bit. So maybe, Yellen was issuing these to kind of control that 10-year. And we saw that it was a huge drop, right? But then something else happened and there became a battle and the 10-year came back up, as did mortgage rates in the space of a day. And I believe what you're seeing here with those two auctions that Jack also mentioned is that had the 10-year auction had a 66% foreign participation rate. That's typically 70%. Okay, so definitely reduced participation. We won't know for some time who was participating in those auctions, but this is exactly what happened kind of during COVID is the world refused to buy the 10-year and everybody flipped out. And so you can imagine that there was a lot of intervention in the markets on Monday when they saw what was happening. And just as Jack kind of mentioned in This Week in Doom, those platforms being down. I guarantee you that you guys may have heard of the plunge protection team, but there were active buyers out there trying to stabilize the situation. But right now, what's important to understand is that the Japanese are going to have to battle for their currency. And as Jack rightly was pointing out, a lot of what the market said happened was because of when that yen weakened again. It was because of Uchida's dovish statement saying they were not going to raise rates in a rocky market. And so at this juncture, I want to just play a quick clip from Weston Nakamura, who's in Tokyo, and he has been all over this. We'll play 2 clips from him, but let's start with this one.
Back to what Deputy Governor Uchida was saying, okay? No rate hikes during times of market turmoil, okay? No all right? Like I just said, we were just talking about rate cuts from the Fed because of that. So him saying no rate hikes during times of turmoil, do you think that justifies that kind of move, this move right here? Okay, because what that implies, if you believe that, what that implies is that that markets thought that the Bank of Japan would hike rates during times of market turmoil. But then Uchida had now explicitly taken that off the table, and so what you're seeing now is a massive relief rally that a central bank, let alone the most accommodation addicted central bank, the Bank of Japan, wasn't going to hike rates during market turmoil and the repricing of those expectations. Come on. If you're watching this right now on the Cross Spread platform, you're all smarter than that, right? I'm sure that none of you guys, you're skeptical about that. For everyone else, come on, that's not what it is, okay? I could say that for the JGB futures market, that might be potentially part of it, because he made other remarks too regarding, he said, for the time being, it's necessary to maintain current level of monetary easing, okay? So I suppose that could be interpreted as maybe walking back the tapering that they just announced, but no, that's me being generous. If he's saying for the time being it's necessary to maintain current level of monetary easing, well, they had the path laid out, just maintain with that, is what that would mean. So I don't even think that that's what it is. Also, there was a Bank of Japan JGB buying operation today that was announced at 10:10 a.m., so there could be reactions to that from the long end. There's also a 30-year JGB auction tomorrow that people might be positioning beforehand, or there's a lot of other factors mixed in with that, but that's why I can see why 10-year JGB futures would move on that, which they did. And JGB long end yields would drop, which they did. But the yen and the equity market rally, no.
So that's a lot of complicated stuff, right? What are the JGBs? Those are the Japanese bonds. But what I wanted to show you guys with this clip is just how complicated this all is. And what we as humans often try to do is put a simplistic narrative over what's happening or what's happening around us. And I think that this is, as trades were unwinding, for instance, these carry trades, and I promise, so a carry trade, the yen carry trade, is essentially buying cheaply in yen and then buying something like equities. But guys, our entire economy is a carry trade. We don't produce things anymore. We are just trying to get a couple of points of juice on these, executions. And so what happened is you had people had to unwind their position, and that in essence meant they had to sell some of their Russell 2000. So this is so complicated. What I really want everyone to understand is that no one headline is going to explain everything that's happening. And so, is this over? I don't think it is. JP Morgan wanted to say that it was 75% unwound. Guys, they have no idea. Nobody has any idea because of all of the rehypothecation that we have in our, financial system. And so, Travis, I want to bring this back really quickly to mortgage rates, but I'll stop there. Before I go into mortgage rates, I want to see if you and Jack kind of have, I know I just said a lot, so you have questions.
Just real quick, and then Jack, Melody, I just wanted to warn people because as you're reading that, it's like they're trying to lower rates to get people to refinance, but people do not want to refinance. Like the danger and the cost of truly refinancing.
Yeah, we'll talk about that. Yeah.
Okay, you're gonna get to that. Okay, that
Yeah.
was it, Jack.
Yeah.
So Weston he sounds very skeptical that Uchida's comments drove some of the price action after that initial panicking on Monday. Honestly, I think he's a little dismissive of that because I think it understates just how gung-ho hawkish the BOJ was right up until Monday, especially the way that maybe not the BOJ, but the Japanese finance ministry, the way on July 11th, when we got that lower than expected CPI print, and then right after that print happened, the Japanese finance ministry steps in and they dump $40 billion in the Forex market, sending the yen strengthening. And if you go look at the yen chart, it's really on July 11th when that cascade of yen strengthening really started that ultimately culminated in that panic on Monday. So the message to traders was, if you're short the yen, you're fighting Tokyo and you're going to lose, right? You don't fight the Fed, don't fight City Hall, all those acronyms for like, don't take on the government. So I think the way the finance ministry pounced on that US CPI headline, and then the way the rate hike came in, 15 basis points, was bigger than the last hike of 10 basis points. And it came at a time when the market wasn't really expecting it. There was only like a 25, 30% odds of a hike. So I think the Japanese finance ministry and the BOJ was very, very hawkish right up until Monday's panic. And then, they come out with that statement on Tuesday. I think Weston is probably a little dismissive. Now, what he gets into later, I think, holds water.
No, I think this is what I'm trying to say, Jack. It's that it's never one thing. It's never one thing. And I think that and what I would argue is that the central banks know what their role is, and that's managing the message. And they absolutely came out to manage the message because I'm sure they got a phone call and somebody was like, what the heck did you just do? Like you get out there, you start managing the message. But what Weston's point is, and I would highly encourage, and we'll put it in the show notes, people to watch the whole video, is he goes into an entire technical explanation of what actually happened during that time period. And he also makes the point that there was a 27-page statement by Uchida. And so even if the algos were reacting like that's how could they really glean all that from the statement? And I'll say this too, Jack, when I was writing my Substack that day, okay, I went out looking for that statement in full because I'd read the Bloomberg headlines. I'd read all of it. I'd gotten it in my Twitter feed, but I couldn't find his statement. Why couldn't I find his statement? And so I think that this is, so I don't, I think we have to absolutely take what Weston is saying with a grain of salt. What we want to learn from his message is that we have no idea what's really happening. And in reality, that the central banks are out there managing messages to kind of keep things under control. But this goes back to the point that market forces are just so powerful. And then because I was trying to figure out, okay, what did happen? Because when you saw like that yen sort of lose that momentum and started going lower, I was just like, what is happening? That was wild to watch. And I want to play his explanation of what happened there because I have found no one talking about this in the press. And so, Travis, if you want to cue up, go ahead.
That's a very good point that you just made, Mel, that it was a 27-page statement that Uchida puts out. And yet the only thing that made it to the press was that one sentence.
That's right.
We won't hike during turmoil, right? So that's a very there's a little bit of cropping going on there to that statement, somewhat abridged. And they zeroed in on the one very dovish statement, ignoring 26.9 pages of everything else. Good point. There's probably a lot of stuff we missed in there.
They probably took it out of the US's playbook on that. And Melody,
I could not find it that day. Now it's probably out there now, but I could not find the actual statement.
Quick question. Is this the K-Pal from X Twitter or no?
Yes.
It is?
Yeah.
This is him? Oh my God, dude, you're famous. I watched all your stuff.
We've also had him on the show, Travis.
I'm going to shut up.
Okay. Maybe take your glasses off. Okay. Can you play the second clip real quick?
Yeah, you done fronting on me, or are you gonna just call me out
I
on anything
think
else, or
so.
no?
I think so.
All
We'll
right.
see.
All right. Here's your second video.
What I think has happened is that at 10:15 a.m. Japan time, or at 9:15 a.m. in Beijing and in Hong Kong, that is when the PBOC does their daily fixing for their yuan reference rate. Okay? Now, the PBOC has been trying to keep the yuan from weakening. And they've been doing so by just doing very strong fixings versus expectations, right? By like, over 1,000 pips stronger than expectations, okay? Well, today, because of the recent yen strength that had actually helped all the other regional currencies, right, including the yuan, today the PBOC actually done the weakest fixing in I don't know how long, but basically almost no gap between the expectation, the actual fixed rate, and the kind of expectations for it. Okay, so China's support for yuan through daily fixing is vanishing like off of a cliff. Okay, because they don't need to strengthen via these fixings as of current, and so as a result of that, you got this is dollar CNH right here in orange, and you got that move, and that happens at 10:15 a.m. 10:30 a.m. is China market open, and that move, I believe that is what had pushed the yen. Right? Let me get rid of like some of these overlaps. If I lose power, by the way, good to know you all. Okay. Like, you could see the chronology. You could see at that moment what had pulled what up. Okay? So, that's what that was. And by the way, the Uchida document, that, once again, that said absolutely nothing, but the Uchida speech, like, translation or whatever, is like 27 pages long. Who the read all of that and immediately just, did that, right? So, what, headline scanning algos, all that? Probably. Maybe. Likely so. I mean, these are all futures driven. But I believe that it was driven by the PBOC.
Stormy out
Oh
there.
my God, that was so wonderfully doomy with the thunder in the background. I freaking love it. Man after my own heart. Go ahead, Melody.
No, and he did a great cover thumbnail for it. And he, so guys, again, very technical. I even saw comments, get to the chase. This is the chase. We have no effing idea what's going on out there. This is so complicated. And what we're trying to do here is not necessarily give you all the answers, but just give you the tools to actually ask the right questions and not believe just the quick narratives and headlines, because it actually does matter, because it matters to the 10-year. It matters to the idea that suddenly rates are going to continue to plunge, because this is a narrative we have heard for time, like since I can't even, for the last 15 years at least, that in times of stress, those rates are going to come down. They're going to come down precipitously. And that's how we're going to get out of this. But if the Japanese and if the Chinese are in trouble like we are, and they are from, their economies are suffering, then they might not be buyers of US debt at the levels that they were. And that's going to have radical impacts and could keep those rates higher. And that's actually what's happening right now. And so, Travis, if you could share my screen, this is where I really do want your expertise. And I want to talk about, I want to talk about what this means. Because like I think Jack mentioned it about the MBA purchase applications, which, guys, I mean, those things are so low right now. They're the lowest in the series. So to have any bounce off the low is really meaningless. But I didn't think about it as a purchase story. I took this active treasury issue story from Yellen, and I know, guys, who was at Treasury when they came out with HARP, Home Affordable Refinance Program, who was at Treasury when they came out with HAMP, Home Affordable Modification Program. They do understand these relationships, okay? And so if they wanted to try to get relief to that consumer who has equity, this is exactly how they would do it. Is that what's happening? I don't know. But let's look at the math. Let's look at how much of a refi boom we would have here. And so in this Substack, I did a really long analysis about the spread between the 10-year and the 30-year mortgage rate and the fact that it's still very wide. And the only way that you could tighten that is if the Fed came in and bought mortgage-backed securities again. But then Christopher Whalen made a really good point, and he's a big banking guy. We differ on a lot of things, but we do share an understanding of these MBS secondary markets. And he said, actually, even if the Fed started buying MBS or mortgage-backed securities again, it likely would not tighten that spread between the 10-year and the 30-year because of the credit risk transfer securitizations that they're doing. Okay, that was a whole bunch of complicated mumbo jumbo that nobody needs to understand. Just know that things will probably not play out like they have before. And so here we have the schedule of the current mortgage interest rates as a percent of mortgages outstanding right now. And you guys can see that the largest population is the 0 to 4.49% or 0 to 4.5 effectively. Now, for us to even clip that, we would have to see 10-year levels go down to in the ones. Okay. And that's what's important to understand, unless that spread started to tighten for some reason, which usually is intervention, which means, guys, we're not going to have a refi boom. And I would also, we will have a little one. We will have a little refi boom, but not one that's going to change housing materially. Very similar. We had a little one in 2010 when rates dropped as well. It did not save many people. But here, ask yourself, there are 2.1 million borrowers already in the money from a refinance perspective. Why haven't they done it? And this is where, Travis, I really would like you to add even more color as to, what is a refinance? What are you doing when you do that? And how are you eroding your purchasing power in the future? And by the way, can you even afford those closing costs?
Well, first of all, do you still need the screen?
No.
When it comes to refinancing, there's so many preconceived notions that it's an automatic benefit if you go from, say, 7% to 6%. So a 1% swing in interest rates. In the industry, a lot of loan officers say that's the time to buy. But the reality is it's actually very expensive to refinance because you have unless it's an FHA streamline or an EARL VA streamline, you got to pay all the costs over again. And the closing cost for a refinance could be to 2 to 4% if you have an escrow setup. So if you're paying your taxes and insurance, if you refinance again, you expect $10,000 in expenses because you have to refill up your escrow. Now, what loan officers do to try to convince people to refinance, say if someone's only saving $30 a month, they'll sell them in that they're going to get a little bit of cash back from their escrow account. But it's just a wash because they have to reset up an escrow account. So ultimately, it can cost 2 to 4% just to refinance. But the biggest thing of all, and this is just as bad as credit card debt, it's an amortization schedule for a 30-year fixed rate mortgage. The amortization schedule is front loaded with interest. So people pay all of their interest before they pay the principal. So if you've been paying a mortgage for 5 years, odds are you've finally started barely paying off your principal. So in 5 years, I may only pay my principal down $10,000 in 5 years. Well, the cost to refinance is $15,000. So if you refinance, not only do you have that upfront cost, you're also using the equity that you've just built up. So if you've just built up $10,000, $15,000 in equity, that's gone because you just paid it for expenses. So it's very dangerous, Melody. Very dangerous. In the first 5 years of an amortization schedule, if you look at a $324,000 loan, first 5 years you pay about $125,000 in interest and only $12,000 in principal. So if you do that, understand you're front loading the amortization schedule all over again, and ultimately you make the banks filthy rich.
Have you ever, Travis, done any study of what would be the tipping point where a refinance really would make sense from an interest rate? Because go ahead.
It's not just interest rate. You can't just look at the interest rate. You also have to look at the amortization length. So for example, if I have only 22 years left, so I only have 22 years left on my loan, and I refinance from a 7 to a 5%, but I go from 22 years to 30 years, I may have just shot myself in the foot because I lost the 8 years. So It really, really depends. I think this is a huge thing. This is the missing piece of the pie. You have your rate and payment, but you also have to look at your amortization. If you can refinance, Melody, into a lower rate, plus also reduce your amortization schedule, then usually it's a win-win. So if I can go from a 30-year to a 15-year and my payment stays the same, that's a winner. That is a winner right there, because I have just cut the term of the loan. The term of the loan is so, so important to look at.
Now,
Guys,
point
yeah, go
something
ahead.
out. That initial screen that you brought up where they were talking about Nouriel Roubini's work about the activist treasury issuance, the ATI, right? Which is basically Janet Yellen faking liquidity on the long end of the yield curve. Notice how, well, first of all, your branding is so wonderfully on point today between them calling Nouriel Roubini Dr. Doom and then the thunder in the background and Weston Nakamura's thing. Just so wonderfully doomy today. Magnificent. But the way the press is flying cover and running interference for Janet Yellen is just it's so laughable here. It is so obvious what Yellen is doing. All right. By issuing T-bills at a higher interest rate to pay down long-term debt at a lower interest rate, that is no different than putting your mortgage payment on the credit card, right? Which is an unbelievably stupid thing to do unless you're trying to make it look like you've got more money than you really do by leaving the money in your checking account. But all you're really doing is screwing yourself because you're putting the mortgage on the credit card, which is at a higher interest rate.
Mm-hmm.
It's so obvious what Janet Yellen is doing. And for the press to be calling him Dr. Doom to try to discredit him and then saying, oh, Janet Yellen is having none of it. Oh my goodness, what a strong, independent woman she is. Oh, give me a break, guys. And this is why I'm just embracing the Doom brand so much. And I just you want to call us Doomers, so be it. We'll embrace the moniker because
better than the fraud and corruption.
Yeah, anybody objectively looking at what Yellen is doing, it's so painfully obvious it's political maneuvering to fake the economy stronger at the expense of long-term pain. And look at how they're like, oh, Nouriel Roubini, Dr. Doom. Janet Yellen's not having any of it.
Did you see the picture of her ordering a sub?
No, she's ordering.
They are doing everything they can for her press image. You know, they had her buying groceries. They had pictures of her buying groceries not too long ago. And now they have pictures of her in a sub shop getting a sandwich. That lady hasn't ordered her own sandwich in the last.
What about the magical mushrooms, Melody, in China? Did you see that? She was tripping on shrooms in freaking China. Did you see that?
No.
Yeah, Yellen was taking magic mushrooms at some magic mushroom dinner in China. And I was like, who the hell is this lady and how does she have all this power? Well, she's doing magic mushrooms with world leaders. Maybe that's
Thank you, President Xi, for the shrooms. The colors I'm experiencing right now are just amazing. I've got to come back here more often. Thank you so much.
It's crazy.
Yeah. Secretary of the Treasury tripping balls in China. It's 2020s, folks. You got to love it.
Yeah, you got to love it.
Yeah, she fits in well, doesn't she? Jack, I was supposed to do the next story, but I think I got it out of order. Are you ready for the next one?
Yeah, I'm ready to roll. You want me to go now?
Yeah, because that was my bad. Sorry. You ready?
Yeah. Share my screen, brother. All right. We are here to talk about the Fed's dilemma. And it's important. Let's get semantic first, because the Fed does not have a problem. The Fed has a dilemma. A problem is an unfortunate situation that needs to be overcome. And the way you defeat a problem is with a solution, implying there is some corrective action you can take and the situation would be resolved. A dilemma, on the other hand, is when you are faced with a choice between two equally bad options and there is no right decision. And what the Fed is facing here is, by all means, a dilemma and not a problem, in that there is no solution. There is only a choice between two bad outcomes. And of course, the choice is, do we cut or don't we cut? And there was a lot of talk this week about should the Fed cut or shouldn't they? As if it's like, oh, it's just a solution. We'll just cut rates, emergency rate cuts, and everything will be fine. Nope, that just causes a different problem. That is one of two equally bad outcomes. So this is a damned if you do, damned if you don't scenario. So let's start with the damned if you don't scenario. What happens if the Fed doesn't cut in September or doesn't make emergency rate cuts? And by the way, they're probably not going to have emergency rate cuts, and they're almost certainly going to cut in September. All right. It's not like this is up for debate here. We're just playing out the scenarios. The first thing, if they don't cut rates, what we're seeing right now is unemployment. And, unemployment rose unexpectedly on Friday. Guys, you saw We had a bad day in the stock market on Friday, and that led to the equally bad or very bad day in Japan and the unwind of the carry trade that caused mayhem Monday morning. And of course, they shut down all the brokerages to lock all the plebs below decks while the ship was sinking. All right, the unemployment rate is a big problem right now. And you can see historically, as the unemployment rate slowly starts to turn upward, recessions begin, and then unemployment skyrockets every time. All right. Unemployment doesn't just casually turn upward and then go flat and stick the soft landing like they've been trying to tell us. Nope, it turns upward and then it spikes. All right. And look where we're at right now. The spike has already begun. If we were to zoom way in on this, you can see as unemployment, it leveled off and then it started to rise. And as it's rising, it's steepening as it rises. And now we're at 4.3%. So unemployment rising is the first of the big damned if you do problems. If the Fed doesn't cut interest rates, unemployment is going to keep rising. Of course, if they do cut interest rates, unemployment is probably going to keep rising anyway. But higher rates is pressuring these zombie companies that don't make money. And so they can't just roll over and refinance their debt. And so they're being forced to lay people off. That will continue if they don't cut interest rates. Another reason the Fed is damned if they don't cut interest rates right here is the federal government is becoming insolvent. Look at the interest expense for the United States government here. Last year, the government spent over $1 trillion just on interest, in the national debt. Interest payments on the national debt are now bigger than defense spending. All right, who had that on their 2020s bingo card? And you can see here, interest is a function both of the principal, which only ever gets bigger. We just passed 35 trillion last Monday, but it's also a function of the interest rate. And right now, especially because the government is issuing so much short-term treasury bills, which has a higher interest rate, the federal government's interest expense is exploding higher. If they don't cut interest rates, the government is going to have to continue borrowing more and more money just to pay for the carrying costs. And so that is a damned if you don't scenario. Another reason they're screwed if they don't cut interest rate is look at what delinquencies are doing right now. Shout out to Frog Capital on X, who is an excellent Twitter account, by the way. He posted this one showing delinquencies. All right. Delinquencies 30 days old. Every single category is rising except student loans. And I would mind you, student loans, that's fake information because the government made it illegal to report student loan delinquencies. It's part of their buying of votes and part of how they're pretending the economy is stronger than it really is. If we were actually being realistic, student loans would be through the top of this chart, through breaking out of your monitor, through the floor, through the ceiling, up into the sky, and becoming a threat to aviation. All right, but that's not happening right now. But you can see here, credit cards rising above pre-pandemic levels. Auto loans rising above pre-pandemic levels. Mortgages shown in yellow here, that's rising, still below pre-pandemic levels, but rising. And mortgages is tied to unemployment. We just talked about how unemployment is rising. Even home equity revolving lines of credit delinquencies are rising. Every category except student loans is rising. Most categories are now above pre-pandemic levels or getting there. And of course, this week when we had the mayhem on Friday, we had this weak sauce from Wharton's Jeremy Siegel demanding the Fed needs to make a major emergency rate cuts. Oh my God, stocks are only ever allowed to go up. The second things go bad, the second the selling starts, shut down all the brokerages, make emergency rate cuts, all this intervention in free markets, right? Look at this stuff. Jeremy Siegel, the market is screaming for emergency rate cuts because they just want the easy money to come back. Wharton's Jeremy Siegel on Monday called on the Federal Reserve to make an emergency 75 basis point cut in the Fed funds rate after Friday's disappointing jobs report. All right, so you can see how the market is, they're just crying for rate cuts because, well, every time the trade goes against Wall Street, they change the rules to fix things. All right, so that's the damned if you don't scenario. All the reasons the Fed needs to cut. All right, that's one bad scenario. If they don't cut, unemployment keeps rising, rises faster, the federal government becomes insolvent, the delinquencies keep rising, and Wall Street keeps crying that they want their rate cuts. Now let's talk about the damned if you do scenario, because again, this is a dilemma. You have a choice between two equally bad outcomes. This is not a problem that has a solution. This is a choice between two bad outcomes. All right. The first, damned if you do. If you cut interest rates, let's not forget inflation. All right. Inflation is still a problem. It's no longer the biggest problem facing the economy. I would say unemployment has become a bigger issue for the economy and for markets, but inflation is still well above the Fed's totally arbitrary 2% target. All right. Does this look like a chart that's still falling to you? Look at what inflation did in 21 and 22. Obviously, it skyrocketed. Then the Fed started tightening and raising rates, and it came down. But guys, inflation in June of last year was 3%, and inflation of July of this year is 3%. Inflation ain't fallen. It's still 50% higher than the Federal Reserve's arbitrary 2% target. So if the Fed shifts into dovish mode all of a sudden, if they start easing again when inflation is already way higher than their silly target, well, then what's that going to do to inflation expectations? If the Fed throws in the towel and says we're no longer fighting inflation, well, you can expect inflation to come back. And let's also not forget that was the consumer price index year over year that we're looking at in this chart. But let's not forget the year over year change coming down. That is not prices coming down. This is the actual consumer price index, the actual pricing levels. And well, does this look like inflation is no longer a problem? I mean, this is why people are so broke. This is why consumers are so broke. Prices went up and they stayed up, and they're actually still going up, and they're not going to go down. All right, those 2019 prices, they're never coming back, guys. And the average consumer doesn't care about the rate of change. The average consumer cares that that price went up and it stayed there, and his wages didn't go up, and now his savings is gone, and now he's canceling his vacation in order to make ends meet. Well, that's very recessionary. All right, so the point is here, inflation for 80% of the population, all right, forget what the academics are telling you and the gaslighting political hacks are telling you. Inflation is still a huge problem for the average person, and it's not going away. And if the Federal Reserve suddenly shifts into lowering interest rates and easing again, well, what message does that send to people about what inflation is going to do? It means inflation is going to come roaring back. And that explains why we get headlines like this. Treasuries slide as investors shun the 10-year sale at lower yields. That was on Wednesday when we had that disastrous 10-year Treasury auction with a 3 basis point tail. And then a day later, U.S. Treasury's $25 billion 30-year bond auction tails 3.1 basis points. A 3 basis point tail is gigantic. That is the market showing we have less appetite for long-term U.S. government debt. Why would the market have less appetite for long-term U.S. government debt? Probably because they know the government is going back into easing mode when inflation still hasn't been fully vanquished. And so inflation is going to come back. And well, nobody wants to lock up their money for 10 years or 30 years at these interest rates if they know inflation is going to come back. And so you're starting to see reduced demand for long-term debt because people believe inflation is coming back. Pay attention, all you people who think just because the Fed cuts the overnight rate, that mortgage rates are going to drop and long-term rates are going to drop. And, oh, I'm just going to pile in the TLT because the Fed's going to lower interest rates. The Fed only directly controls that overnight rate. And if the Fed sends the signal to the market that they're done fighting inflation, you could see long-term interest rates rise even as the Fed is cutting, because long-term interest rates are more determined by things like liquidity and long-term inflation expectations, which could all be stressed if the Fed starts to ease too soon. And last but not least, let's not forget what that mayhem was on Monday, the unwind of the yen carry trade. All right. And the biggest reason why we have the yen carry trade is because of the huge gap between interest rates at the Federal Reserve and interest rates at the Bank of Japan. You can borrow cheap Japanese debt and then convert to dollars and get better interest on the US. And so you can carry that yen debt while making more interest on your dollar assets. All right. Now look at this chart here. Do you see this, the red line down here? Look at this little bitty bump that we got in Japanese interest rates last week. Do you see it? I mean, if you squint and you put your face right up to the screen to the point where it starts to fog up, you can just barely make out the increase in Japanese interest rates. So the gap between U.S. interest rates and Japanese rates shrinking by that much was enough to cause that mayhem on Monday and the unwind of the yen carry trade. All right. Now, that wasn't the only cause, but it was a big contributor here. Now, what happens if we go along with Jeremy Siegel's idiotic 75 basis point rate cut idea that he was saying we need to have our big 75 basis point emergency rate cut? Well, that's going to take this black line all the way down to 4.5. It's going to further shrink the difference between U.S. interest rates and Japanese interest rates. So if the Fed is not careful and they cut interest rates, they could actually expedite the unwind of the yen carry trade, which could cause even more mayhem in stocks. And if they're not careful, it could blow up some of these trading firms that have massively piled into the short yen and short volatility and long AI stocks, which are all just different variations of the same stupid trade, even though they tell themselves they're diversified. And so the Fed cutting rates could actually create the conditions for further unwinding of the yen carry trade. And that's why this is a dilemma for the Fed and not a problem. They are damned if they do, and they're damned if they don't. That's what I got, guys.
You want to go, Trav, or you want me to go?
No, I mean, I'll go real quick. I would say just from you reading that and just looking at the comments, man, I'm just more convinced now more than ever that like a black swan would be consumer awareness, especially millennial awareness. And again, just I'm not picking on anyone in the comment section, but I see comments like, one particular comment where this person was in high school in 2008. And they assume that because they went through the GFC that they know about it. And they go on to say, my parents went through it. I saw what my neighbors went through, but no, you didn't. If someone was supporting you financially during the great financial crisis, then you assume you know what it was like. You know nothing about what it's like because you know nothing about supporting other people through a financial crisis. And by having that misconception that just because you were alive with a pulse during the GFC is only going to fool you into thinking that the market's not collapsing, that it's not broke, and that it's not full of fraud. I'm sorry if those words hurt you, but that's exactly what's happening right now. And so I think that, again, the black swan is millennials especially waking up.
And,
so that wasn't a question.
Yeah, I would just say to the millennials, when you hear these things like, oh, the Fed is going to make emergency rate cuts and we're going to restore liquidity in a functioning bond market, understand, guys, all these things that these bankers and financial elites are doing that they're telling you is for your own good is all at your expense. Because when the market crashed in 2008, at the very least, some people were able to take advantage of the lower prices and get into a housing market that a few years ago they had been priced out of. And so all these steps that the elites are taking to keep this bubble inflating and to keep this can rolling, they're telling you it's for your own good. Understand, you, the millennial, are most victimized by this easy money, by the lowering of rates and the printing of money to ever inflate this asset bubble. All right, let it crash is the best thing that could happen for millennials, with the added caveat that, yes, that means higher unemployment too. It's not a pain-free option. This is a dilemma, after all, a choice between two bad outcomes.
Thank you, Jack. That was amazing. I think the one thing, because everybody wants to know, and I'm asking the question for everybody, and it's do you think that the Fed is going to cut rates in September?
Yes. Yeah, I think that is a foregone conclusion at this point. The question now is, do they cut by 25 or do they cut by 50? It's about even split right now. If you look at interest rate futures, what they're going to do, I think they go 25, because if they cut by 50, they would be admitting that they waited too long. They would be admitting that they got it wrong. They would be further losing faith or losing the confidence of people, which I can't believe they have any left. But after transitory and after the ridiculous soft landing narrative, if they all of a sudden go from higher for longer to a 50 basis point cut, they're going to project panic, and it might actually be counterproductive. And then if people realize, well, the Fed doesn't have this under control, again, beware those long-term inflation expectations. All right. If they ease too hard, too fast, they could cause those inflation expectations to rise. And that could actually result in higher interest rates, not lower. Because
Exactly.
those long-term inflation expectations, that's what drives the 10-year and the 30-year. And
Which are the rates we care about, right? In
absolutely.
terms of credit creation, right?
And let me just say one other thing, guys, that's pretty important. Ben Bernanke in 2005 and 2006, right? He saw the housing bubble coming and he started raising rates. And the idea was, we want to take the steam out of the housing market. I forget the language he used, but they wanted to cool off the housing market by raising interest rates to make homes less affordable. So people stopped taking mortgages they couldn't afford. And so people stopped bidding up the price of houses. But what he didn't take into account was those adjustable rate mortgages that were out there. And as he was raising rates, that pain wasn't being felt all at once as he was raising it. That pain didn't show up until a year or two later, when all those teaser rates expired, and then all of those rate cuts came flooding in all at once, and now people's mortgage payments went from a few hundred to a few $1,000s because their teaser rate expired, Ben Bernanke accidentally caused the wave of foreclosures that he was trying to prevent with his rate hikes. And much the same way right now, if Jerome Powell is not careful, if he cuts too aggressively, he could cause the unwind of that yen carry trade. He could accelerate it. And the unwind of the yen carry trade would create a sell-off of U.S. government assets, U.S. stocks, U.S. Treasury bonds, as that money floods back into the yen for safety. If he's not careful, he could actually expedite the unwind of the carry trade, which again would send interest rates higher, not lower. So, you know, there's some similarities here where if Powell's not careful, he could pull a Ben Bernanke and have the opposite of the desired effect.
Right.
You're so smart, Jack. How do you get so smart? What vitamin regimen are you taking?
Vitamin, a lot of turmeric for the back. That's about it.
Turmeric. The
And
spicy?
coffee.
Is that the spicy stuff?
Copious amounts of coffee.
Really?
Yes.
I already had my coffee. I'm on my energy drink. This is a really good comment, Melody. Melanie and I just did a video, Jack, on like foreclosure data, and we were trying to bring attention to the fact that only 10% of mortgages were subprime back in the GFC, right? Because I was like subprime. And then look at this comment. Okay, again, 10% was subprime. They're saying that 15% of this is like mortgage applications, not actual mortgages, are adjustable rates. Do you know that? Is that for sure, Melody?
Jimmy's probably getting that off the Mortgage Bankers Association website. You know, they were at around 7% for the longest time, but what he might be talking about is there has been an uptick recently in those ARM applications. But fun fact, like looking at JP Morgan's results, very interesting. They didn't talk about this in their earnings release when they did their presentation, but their HELOCs already 6% delinquent. And the other thing that I was reading in that disclosure is that they have over $90 billion in interest-only loans. Like, so I guess my point is, guys, as much as everybody's been out there saying that there wasn't risky lending, that is just absolute hogwash. It happened. There's just been a lot of credit quality gospel singing.
Jack, good comment right here. Do you have any idea, Jack, of what you think unemployment might be, being that, you know, they're saying we have more black swans potentially now versus GFC?
Yeah, Trav, if you share my screen again real quick, I can answer TA's. And thank you so much, TA Chapman, for supporting the channel, by the way. I appreciate that. Let me read it real quick, and then you can take it off the screen. What was the unemployment rate at during the GFC? And do you think we'll see over 10% this cycle with the multiple black swans that feel like it's inevitable to see massive unemployment? All right, could we bring that down, Trav, now so we can see the chart? I mean, bring the comment down so we can see the chart. And then share my screen. There we go. Okay, so here's unemployment through the GFC. You can see it leading up to and then during. So we bottomed out at unemployment in 2006 around 4.4%. Now, the bottom pre-GFC was higher than where we're at right now. So we're starting from a much lower point. That's an important thing to point out there. Now, the other thing you can notice is, again, the GFC, they're saying the recession didn't actually start until December of 2007. But you notice unemployment actually started to rise several months before. We got to 4.5, 4.6, 4.7. And then all of a sudden it steepened and it goes vertical. And we ended up peaking at 10%. All right. So we're already into that accelerating phase. If we now zoom all the way out to where we're at here, we're already kind of into that starting phase where we've started to accelerate to the upside. Now, do we see 10%? That's pretty hard to gauge. My gut tells me if you add up all of the cumulative black swans, the commercial real estate bubble, the AI bubble, the yen carry trade, sovereign debt crises, all of these things combined, plus a lot of the unresolved rot in our financial system from the GFC that was never really resolved, the potential for higher than 10% is absolutely there. And I would also add that all of the things that they did in 2008 and 2009 to stop the GFC, we didn't have the inflation problem that we have now. And so I don't think the Fed has as many tools in their toolbox to address the problem of higher unemployment this time, not without spooking those inflation expectations, inflation is still fresh in everybody's mind. So some of the tools they used in 08 and 09 could potentially make things worse this time around. So I think the potential to go higher than 10% is there. But I do think we're probably getting a little ahead of ourselves. I think we're probably, I mean, obviously we see 6-7% beforehand. And it's all about how long does the Fed wait to act? What are those actions? Those are some pretty big variables that until we see what that looks like, it's going to be hard to say where we stop. But I would say maybe is probably maybe it's a bit of a cop out, but the answer is maybe. But we definitely have the potential to go higher than 10%. Absolutely.
Okay, very good, very good. I'm gonna read anything else.
Nope, that was it. Thanks again, T.A. Chapman. I appreciate the super chat, brother.
All right. Well, we're going to get into the next thing, which is basically listening to Kathy Wood. She's going to make, first of all, if you guys know who Kathy Wood is, she was very famous, probably, what do you think? I mean, she was everywhere in 2019 to 2021. And then, you know, she's got crucified because she's been wrong for so long, but she's come back into the picture and she's actually made some really interesting comments. And I wanted to get both Melody and Jack's reaction on what she's going to say, because she's finally like warning people and talking about the reality of what's going on. And then Chris, brother, I see you. I'm not going to let you call in, man. I mean, did your mom tell you that was a good idea? I mean, geez Louise, dude. If I wanted to listen to your opinion, I'd just go on Wall Street Journal and listen to all the kids be optimistic, overly optimistic. That's no offense, Chris. I'm just trying to help you become stronger. But regardless, let's put this up here on the screen. Melody's shaking her head. I'm going to get in trouble later. I already know that. Boom, boom, boom. Here we go. All right. So if you guys can, let me know the
You just went
mute. Put myself
Jeff.
on mute. I know. So we're gonna listen to the first minute of this, and listen closely to what she's gonna say. She's gonna talk about the volatility in the market, essentially matching the volatility in the markets in 2008. So I think this is really cool. Let me know if the audio is okay.
Greetings, everyone. This is a very active time in the market. I don't have to tell you, but this week the VIX crossed 65. Which is the fourth largest measure of volatility in the market, really in the last 40, 50 years. And I've been around for all of them. So it's fourth after 08, 09, the tech and telecom bubble in 2000, and 1987. Now, what does this mean, this volatility alert? It usually means the market is meeting a cathartic moment, or is in a cathartic moment. And it usually means something is changing. And as you know, we have believed for quite some time that the U.S. economy and maybe the global economy has been going through a rolling recession.
Okay, I have two things I want to talk about. I want to ask you something, Jack. I want to ask you something, Melody. Melody, I'm going to ask you, is there something changing? Jack, I want to get your opinions on, are we in a rolling recession?
Me first, I guess.
Yeah, you go first. All right, so then your question is what's changing, Melody? Is there something changing in the market, you think?
I love the way they talk. It's so funny, as if they actually know what's happening. I mean, the surety, and in such an academic style, right? I felt like I was definitely at a conference, an academic conference. But I heard a story, and I would love if the community could find it for me. But I actually heard that the VIX didn't go to 60. It was a technical miscalculation. And this was a story nobody was talking about in the press. And I cannot remember where I saw it. Maybe Julius, somebody. So I would love it if somebody can find that story for me. But guys, she doesn't have any clue what she's talking about. I mean, that is crystal clear. Just look at her results. And so as Wally was giving us some trouble in the comments about, doomers are right and people who talk about a boom are eventually right. But what's their motivation for what they're saying? And I think that's critical, not whether we're going to be right in a couple of years or in the short term. That's not really the point of us being here. And so, but guys, she wants you to think she's right. Absolutely right. So you will follow her right off a cliff, as so many have already.
Jack, can you talk about the rolling recession?
I don't know what a rolling recession is. I don't even know if Kathy Wood knows what a rolling recession is, but when you put on your big frame glasses and say it, it makes you sound edgy and in touch and financialized. So sure, Kathy, rolling recession. I'll embrace the recession without understanding what the hell the qualifier rolling means. Now let me just say, Kathy, I hear what you're saying and I agree with what you're saying, but do you understand what you're saying, Kathy? Because the headlines I saw today said Kathy Wood buys $50 million of pummeled tech stocks. All right. So Kathy Wood is out there buying stocks right now after just telling us we just saw the fourth biggest VIX spike in history behind the GFC, COVID, the dot-com bubble, and Black Monday in 1987. All right. Well, those VIX spikes were all precursors to some of the biggest stock market declines of our lifetime. So Kathy Wood is out here telling us the VIX, which is the fear gauge, is spiking. And that means is catharsis. Something is changing. Oh my God, the vocabulary. It's so wonderful. Well, then why are you buying tech stocks, you idiot? If you're telling us the VIX just told us the worst stock market since '08, COVID.com and Black Monday, then why are you out there buying tech stocks? She doesn't understand what she's saying. She's just saying something she read somewhere else as if it's her idea. And then she's doing what she always does. She's buying tech fads. That's all she is. She is a one-dimensional fad tech buying automaton. And I don't know why they keep putting her on screen in CNBC, because all she's done for years is lose money.
It was very Theranos-like, right?
Yes, a very
Elizabeth.
carefully crafted image
Yeah.
and persona. Absolutely, Melody.
Yeah.
Yep.
Yeah. And people fall for this every time. It's so funny. What's
mean,
her
it's-
name? Oh, go ahead.
No, there's more. This was just the first segment. You guys ready
Oh.
for the?
I don't know if
And
I
I
can
just-
take more, Travis, but okay.
There- No, then okay. So the next part's going to be about Japan, the yen, the carry trade. It's
Oh,
only
God.
1 minute, but real quick, I don't want anyone to think I was making any mom jokes, so I just want to explain real quick. I wasn't making a mom joke. I was joking that you thought you knew what was going on as your mother was taking care of you, right? Like if you were in high school during the GFC, I was making fun of you, Chris, not your mom. I think your mom is probably a great person if she was able to support you during a horrible financial crisis. And Melody, I'm sorry. All right.
Thank you.
So we're going to listen to this. I'm going to get your reaction. I'm just feeling spicy.
Involving borrowing yen, so really shorting yen, and buying dollars and investing them into higher yielding assets than in Japan. So playing the spread. The other reason this became a very widespread trade is the yen has been depreciating. So shorting yen meant that the investor or the speculator was benefiting from the yen going down. Well, that changed abruptly this week as the Bank of Japan increased rates more than expected and seemed more determined to continue increasing rates than many people expected. So
I got a couple things here. I mean, that was a lot.
Is this
I
the
really want you
Vulcan?
guys-
How do you do that? Did you guys see that? It was like the Vulcan hand.
Can you
what
do that?
Yes.
But
Okay.
but like what's crazy is like she's talking about multiple things, multiple
Right.
reasons, but I wonder, what do you guys think of like how they're playing the yen and like the devaluation and like the shorting it? I don't even know how that's legal in the first place. Like what is your take on all of that, Melody?
Jack looks like he wants.
I mean,
Jack,
everything
wanna-
she's. I'll take it. Sure, everything she said there was accurate. She just described the basics of the yen carry trade, which we've been
Right.
talking about for a while. But again, I got to get back to okay, Kathy. If that's what's happening, then why the hell are you buying tech stocks? Tech stocks are among the primary beneficiaries of the yen carry trade. So if it's really unwinding, why are you buying more of what's getting sold as that trade unwinds? I understand what she's saying. I don't think she does.
That's right.
Melody?
No, I just continue. I can't even take it seriously. I'm sorry. It's just the way she even talks and the hand gestures and just it's very TED talky. And There's just not a lot there, guys. And as Jack said, these, she can trot out these talking points, but this is not who you want to be following. So
okay, fair enough. Now, this next part, though, I think you guys, again, I think she's made a lot of progress. Listen to what she's about to say now.
oh no.
I think it's pretty good. It's about layoffs and how the stock market is like, that's really where a lot of the spending's coming from, like the stock market. So if that stock market goes down, it's going to mess the consumer up, and then the Fed will emergency rate cut. So she's always going back to that emergency rate cut. Take a listen.
But I do believe that the Fed now is on high alert because the stock market seemed to be encouraging the Fed to hold tight, higher for longer, make sure that inflation was out of the system. And as you know, we've been saying for quite some time that inflation is unwinding much faster than we're seeing in the traditional indexes. Right now, the CPI is at 3.1, but by other metrics, we're seeing prices fall. And we would not be surprised to see prices fall a little more broadly as the consumer weakens. Now, why is the consumer going to weaken or continue weakening? We believe it's because corporations are losing pricing power. And in order to salvage margins, they're going to be doing two things. They will be laying people off, and they will be accelerating moves to increase productivity. So the unemployment rate will go up. That certainly is getting the Fed to change its spots, as we're listening to Chairman Powell. And I think now that household net worth being hurt by the stock market going down is another reason that the Fed is going to relent. Now,
We know that that's what she hopes. She hopes they will relent. But Melody, if I can pick on you first and not Jack, can you just go into like what hit me when she was talking is, again, how important NVIDIA, right, that the stock market is, and how a lot of that consumer spending may be wrapped up in the stock market. And so if the stock market goes, maybe everything will go. We've had this talk countless times.
Yeah, so I definitely think that this recent run up in the stock market has impacted sentiment, and for our cinnamon, as we sometimes say, sentiment, in terms of our top 10%, our top 20%. But the bottom 80% is already deeply distressed. And so I just think that, yes, if the stock market goes, you're definitely going to see more pain in the top 20%. But by the way, they're already feeling the pain. A lot of those in the top 20% are not getting, they're getting cash calls. They're, if they were LPs or limited partners in multifamily deals, they're not getting their payouts. I mean, so a lot of the super prime are actually coming under stress as well. Something I've been looking at recently is all the celebrities and stars that are selling homes. Guys, they are selling them at an accelerated pace. And this is because they can no longer actually, carry these costs in a way that makes any sense. So is she correct that everything will go? I think she is underestimating the weakness that's already there, and that it absolutely, if the stock market goes, there's really, it's going to be a bloodbath, but there's already enough to keep us on a path to unsustainability. Go ahead.
But isn't it fair to say that a way for the elites and the government, the powers that be, to manipulate the sentiment is to manipulate the stock market? Is in other words, isn't that the last thing that people are holding on to? We know it's not the labor market.
That and their wealth effect through their homes. I mean, these are the last two things. I would say it's really the wealth effect in their homes. And to your point, I wouldn't call it a black swan, but a gray rhino would be millennials waking up to what's actually going on. But then the stock market. But the stock market's important to a very limited number of people in our country.
Very good, Jack. What do you, any thoughts on that segment? You are muted, sir. You are muted. I love when Jack's muted. He still doesn't know he's muted.
Yeah, I know. I just couldn't find the window to unmute myself. All right, so I got a couple of issues with what Kathy said there. First of all, the statement that the stock market had been encouraging the Fed to hold fast at higher for longer,
Right.
flat out false. All right. For the last 24 months, every bad piece of economic data has been met with the stock market rally because the market got so excited that the Fed was going to Zerpenberg again every time bad news came across. All right. So the Fed has been encouraging the stock market has been demanding cuts since they went away. That's just what the stock market does. So she's just flat out wrong there. Now, the other thing that she was mentioning here about the wealth effect and about the stock market coming down affecting households, that is also incorrect. There's a very famous study done by Case, Shiller, and Quigley after the GFC. And Case and Shiller, you guys are probably familiar with them because of the home price index. Quigley's less famous, but they did a study on consumer behavior and what the stock market does to consumer behavior and what the housing market does to consumer behavior. Stocks do not change consumer behavior. Stock market going up and down doesn't change people's spending habits. Home values going up and down absolutely changes people's spending habits. So for the average consumer, home values are way more important than stocks. And Kathy Wood is wrong about that when she's suggesting that the stock market is going to have this wealth effect on spending. That has been studied ad nauseum and is just not correct. And lastly, once again, I just don't think Kathy Wood understands what she's saying because she just got done telling us about how the yen carry trade is driven by the arbitrage between US and Japanese interest rates. And she's saying the unwind of the carry trade is going to encourage the Fed to lower interest rates. Well, that will reduce the arbitrage between Japanese and US rates, which will speed up the unwind of the carry trade. So again, Kathy Wood doesn't even understand the words coming out of her own mouth here.
Question. So, so you guys point like the stock market euphoria, not a big impact on spending. It's more the home equity. But what about renters?
I think we go back to Travis. So I'm aware of the study that Jack is talking about, and I would agree that stock market doesn't have an outsized impact, but I think in certain locations it does. Like in California, you could definitely see more movement in that market as NVIDIA started to go crazy because there's a lot of tech people that live there. But I agree on balance, it does not have a huge impact. So, but Travis, I think in terms of what was your question again? Sorry.
What about renters?
Sorry. I told you I didn't get sleep.
No, there's a lot.
Renters, right?
Renters.
Okay. Right.
Well,
they don't have a house.
They don't have the stock market. I mean, they're mostly, okay, that's not fair, but really it's like most of stocks are owned by that top 1% in our country. And so those folks, they might be strategically renting right now, but that's really not, that's a choice that they can make because of their financial situation.
Okay. All right. Anything else Melody, you're awesome. You always put me to shame. That's why I appreciate hanging out with you guys. You always want to hang out with people that are smarter than you. So I don't know why you're hanging. But Jack, anything you want to add to that segment before we move on to our last segment from Melody?
No, I feel like James Carville in Old School here. I have nothing to add. That was perfect. So.
Melody, you ready?
DuckTales. Yes, I love it. Okay. All right, you can share my screen, and I have a little boring story today that I want to talk about, but I think it's really important about the state of kind of what's happened as we have stopped sort of investing in productivity and really redirected all of our, capital into share buybacks and things like that. So this is a story about a little plant down the road from me in Bristol, Tennessee. And the headline is a key American plant making antibiotics for kids risks shutting down. Okay. So at the height of this plant, they make amoxicillin. This is key to so many, this is a very widely used antibiotic. And they started off in the 70s. They had over 500 workers. But now they have about 62 workers. And so what's happened is they lost their patent. And we'll get to that in just a second, but they're not really able to make money. But as typical, the story has a bunch of nuance that we want to talk about. And so I'm hoping actually to interview somebody from this plant. So stay tuned for that. But, we have a lot of key drugs that are actually in a shortage scenario right now, and we rely a whole bunch on overseas partners to supply a lot of those drugs. But guys, amoxicillin is, I mean, I think most would argue this is a key drug that we need to have. And what's happening right now is they cannot sustainably produce these pills. And so, even though, and this is what's fascinating, some of you may say, well, wait, my cost of amoxicillin hasn't gone down. But in reality, this last sentence is what's super important. Americans might not be aware of this price drop because the price they pay is determined by opaque negotiations between drug makers, insurance companies, and middlemen. Okay. And so even though these guys at the plant can't get a decent cost for their drug to sustain operations, we still may be paying more. And I think that's really important to understand. So basically, what happened is the owner of this plant filed bankruptcy in 2020, and you had someone come in, his Rick Jackson, to buy up this plant. Now, that would have been awesome, right? He comes in and maybe he thinks of different ways that they could re-engineer production, ways they could save money, and really, change this around so that we could produce these drugs in this country. But in reality, what actually happened is that he bought this company because he was trying to get at the government grift table with a subsidy. And so, this is something I think Jack has talked a lot about as well with Steward Healthcare. We tend to have this just, shortcut to, okay, let's have the government subsidize it. But here's where and this is an article I want to talk about with you and Jack, Travis, is just the perverse incentives here. It's not about getting more productive. It's about actually just getting dollars from the government. And now, of course, we can sit and think about how much of our economy is now propped up by this government intervention, these subsidies. Essentially, even Elon Musk has said that we shouldn't have all, even though he's profited more off of subsidies probably than anyone in this country. But, in essence, the argument you get here is it's an argument I think is a little disingenuous. But what they're trying to say is, hey, if there are subsidies for EVs, why don't we have subsidies for antibiotics? And that kind of sounds logical, right? But the problem is, why are we even going for those subsidies at all? Why can't we used to be a nation where we could innovate and we could engineer, great feats. And basically, but, through globalization and a whole bunch of really complicated things that have happened that have not worked to benefit the forgotten American, through this global supply chain, essentially we can't produce anything anymore and make money in this country. And we're all standing at the government. Now, interesting about this Rick Jackson character, another thing, he wants these government subsidies for these for his antibiotic plant, but he also was very much trying to privatize foster care. So this is I'm not going to go into that too much, but again, guys, this isn't about, in this case, what you would love to hear is that some private business person came in to save this plant and turned it around and made it profitable and lobbied, for fair pricing or something of that nature. Instead, what it was is an opportunistic businessman came in hoping to get that government payout. And so essentially, the last line of the story, Jackson says he'll keep the plant open until he hears a firm no from the government, but he's not going to support it forever. And I cut it off there, whatever that he means. But so this is a very complicated story where we absolutely need, and you can stop sharing my screen, Travis. We absolutely need these drugs. They're critical. But at the same time, the answer cannot be government subsidies because, and also what it says in this article is that essentially that's just going to inflate prices even more for us. But it's really about Medicaid being involved here that has made, those negotiations for those drugs that have made it unsustainable for this plant.
Yeah, I just love when the government makes things affordable, like childcare, like housing, like college, like healthcare. My God, the worst thing you could ever find out is that the government is going to make something affordable. Or better yet, the best possible scenario would be the government wants to get involved in making something you sell more affordable, because that usually means dollar signs for you. Now, the thing that really gets me the most here, Melody, is who's acting on behalf of the consumer in this whole thing, right? You got like companies like CVS, right? CVS owns the pharmacy. CVS owns Aetna, the insurer, and CVS owns Caremark, the biggest pharmacy benefits manager, right? And supposedly the pharmacy benefits managers, they're negotiating with the drug companies to get the best possible deal for the consumers. But the drug companies are also providing economic incentives to the pharmacies to get their drugs added to those pharmacies' formularies. So how is CVS possibly negotiating on behalf of the consumer when their pharmacy benefits manager is negotiating with the drug company that's bribing their own pharmacy to list their drugs? And then how is the pharmacy benefits manager negotiating with the insurance company that's owned by the same parent company for the consumers who are buying the drugs from their pharmacy? CVS has their hand in every single cookie jar. They're on both sides of all of these negotiations. Nobody is representing us. Nobody is representing the consumer. And so, I don't know how it's possible. There needs to be something like a fiduciary rule in medicine. Somebody cannot be allowed to be on both sides of a negotiation where neither side is representing the consumer or the patient or the doctor. These are just executives negotiating how much money they're going to squeeze out of us. There are no doctors involved and there are no patients involved in these discussions, and yet it affects the doctors and the patients. And
money.
You're right, Melody. It's the grifters. And where does this road? All roads lead to more government handouts for me. Let's take even more money from the taxpayers and from the people via inflation to incentivize this. And I don't have the silver bullet to this problem, but I can tell you the way we go about it always makes it worse.
Mm-hmm.
Travis.
Melody, the thing, I mean, Jack just pretty much knocked out all the points, but it's just, I see just the same thing happening with the corruption and with the greed is these people take advantage of people in bad shape. Like realtors will take advantage of people that have the wrong expectation of the housing or have no experience or their assumptions are wrong. Realtors will just lead them right off the cliff. And it's like, where can we go just to get help? Where can we go to not get taken advantage of? Where can we go to get honest advice where it's just not to profit off of us? I mean, it sucks. I mean, because the thing is like the methadone, Oxycontin, Adderall, I bet you the shelves are popping with that stuff. I bet you, their profit margins exploding, but antibiotics, we have a shortage of that. So it sucks, Melody, because I feel like what's happened here is the system just makes so much more money off of the pain, off of addiction. They're profiting off of addiction versus profiting off of cure. Addiction is more profitable than cure, because cure, you're done, you move on. Addiction, you got to come back. You got to keep whatever they're doing to you. So it's just the whole system is really unfortunate. And it does make me sad. I'm happy for the community. I didn't mean to, be spicy a little early. I was just playing because I'm really happy. I mean, I feel good about where we're at. I feel great about the community, and I appreciate everyone. But I wish you started with this, because this is making me feel like a little baby, because this is health. And that's the same thing with the lockdown. Do you guys remember the division on the vaccine? Do you guys remember that division? Like if I didn't get the vaccine, that's not proven, that had no investigation done at all, then I was not a patriot. And then the people on my side, because I didn't get the vax, were like, you guys, it's just the division over people just wanting to be safe is sad. And I'm sick and tired of people profiting off of our insecurities. And that's, I don't know how to say it.
One more point I would make on this story is, we've got this, we just passed the CHIPS Act last year, and we're trying to build all these new semiconductor fabrication facilities in Arizona and Texas, because we get all our chips from the South Pacific region, right? Japan, China, Taiwan, which is probably the next war zone. I hope it's not, but we're doing this big chips reshoring effort right now to insulate us against the disruption of the semiconductor industry in the event of war. Well, all of our medicine is also made in China and made in that part of the world. And if we're really like, yeah, grab the flag and march off to war, let's feed bodies into the meat grinder. Well, what's going to happen when there's economic embargoes and trade wars along with this? And now we can't get any medicine at the same time. And I don't see anybody ringing the alarm bell on this. I don't see any great effort to reshore medicine manufacturing into the United States. They're worried about their chips. They're worried, oh, we got to have the semiconductors to put into the backup cameras on an $85,000 electric pickup truck. I don't know why anybody would buy something like that, but nobody's worried about, hey, antibiotics, the stuff that keeps us alive. We get it all from China.
Right.
Something we might want to think about.
Right. And, I think that what's happened is we're in a medical dark age. And I think that, because you've had so little investment in a lot of the drugs that could be truly beneficial for humanity, and so much focus on the drug, like Travis was saying, the drugs that can sell, and also the ones that they can, create an addiction for and sell even more. And so I think, these are the things, guys, though, when your kid is sick and has strep throat and you can't get amoxicillin, what happens next? And so, listen, when this happens at scale, these are the types of things that turn the tide of social sentiment. And these are the types of things when your kid has strep throat and could lose their hearing because you can't get amoxicillin, that's when things are going to get really serious in this country. And what I would hope that we all kind of do is start rallying around these issues to figure out solutions. And for me, I really would love to understand, and I may dive into the story a little bit more, like, how could we turn this plan around? Like, and I'm sure it's, to Jack's point, it's very complicated. I'm sure so much of it is being sourced from India, China, other places like that. And then, of course, if we wanted to get it somewhere else, we'd have to go through a ton of red tape. But how could we do it? I think that's something I would love for the community to think about over the next week. And if anybody has some suggestions, because this is these are life-saving drugs. And that is, guys, if we run out of those and we can't get them from China, the American people are not going to put up with that for very long.
There's power in numbers, Melody, and I would say one of the solutions is the power in numbers in the kind of like what Mitch is doing, petition, bringing people together, and multiple lawsuits. It seems like it's so systemic. The corruption is so systemic. The only way to fix it is to start over. It's an impossible system to fix. The greed is everywhere. It's systemic, straight up. You guys ready to do comments, or do you want to add anything else, Jack?
No, I would just think a very simple thing we could do is to say pharmacy benefits managers need to be siloed companies. And I don't think that would be anything like price controls. I don't think that would be over-regulation, just that it isolates their interests with those of the patient, which is what they're supposed to do. The pharmacy benefits managers should be acting on behalf of the patients, not on behalf of the pharmacy, not on behalf of the drug companies or the insurers. The whole idea of the PBMs is that they negotiate and force in numbers for the patient. And too often than not, the pharmacy benefits managers, their interests lie elsewhere because of they're owned by parent companies who own those other participants that they're negotiating with. So I think that's a very simple thing that Congress could do that would, at the very least, give the patients a seat at the table in those negotiations that right now they don't have.
All right.
Like it.
Let's move on, guys. I guess to the final part of the show. I start some questions, starting with Steve. I want to knock this out, but I wanted to give a special shout out to Steve. Steve's an appraiser. Steve reached out to me, and because of the Central Appraisal District fraud and the corruption, and we're trying to expose that. And so he's an appraiser. And Steve, I appreciate you. I got your email. I would like to know more about mass appraisal. So Steve is actually going into, and I'm hoping he can teach me more on the regulations about how the county appraisal district, central appraisal districts use mass appraising versus the localized appraising. So I appreciate you, Steve. But the fact that the 10 and the 2 uninverted last Monday briefly does not mean that we're in recession. Understand that the 10 and 2 is just an indicator of an incoming recession. And it is one of the most trusted indicators because there's so many different things that go into this one set of data, but it does not mean that we're in recession. This is just a warning. Did you guys want to add
especially when
anything?
they can manipulate it? Right. Especially if they can change the debt
Yes.
issuance and then manipulate it. So it's, guys, there's not one sign out there. I wish there was. There's just not.
Yeah, I would add, forget the technical definitions of recession, which we don't meet right now, because the government debt spending or government deficit spending is 7% of GDP right now. That's much, much higher than prior to any of the previous recessions. If our deficit spending was more in line as a percentage of GDP to where it was in some of the other prior recessions, we would already be in a recession. And then what the Treasury is doing, manipulating the 10-year lower, and the Fed is manipulating the 10-year lower. So go by what you're feeling. And again, for 80% of Americans right now, probably 90%, we're in a recession already. We have been for probably a year and a half. And, don't get hung up on the nuance and the academics. That's what those quacks in the financial press like to bicker about and argue about. And usually they have political motivations to do so, not to mention financial incentives
Yeah.
to keep people sending their money to the
say.
financial services industry. So
What's bigger?
yeah.
Probably the finance. So here's a good one, Melody. What do you think about if the Fed does, because the market is now convinced and actually is convinced it's going to be more than a quarter basis point. Do you think if the Fed doesn't cut in September that it would wreck the markets, Melody?
No, because everybody thought they were going to do 6 cuts this year. That didn't.
They're already wrecked.
No, yeah. So again, it's just narrative. I don't think it would wreck the market. I think that whatever you're seeing it right now, guys, they've come out full court press trying to say that the unemployment report didn't really matter because you look at the jobless claims and everybody was just panicking and it's not a big deal. They're going to do the same thing and some other print will happen. I mean, when GDP prints, for instance, I think that's kind of what saved them this time around from not making that cut in July. Like we could be back up again talking about inflation. And so I just think at this point, really, and I may be saying something crazy, but I think what's happening right now is market fundamentals. I'm not talking about fundamentals like price to earning ratio or anything like that. I'm talking about the market, the liquidity shortages, the collateral shortages in the system. They are the prevailing forces right now, and they are going to determine what happens in the stock market.
I brought this comment up here because all three of us, just for the viewers, all three of us got wrapped up in the great financial crisis, just different levels of distress. And because people sometimes get me confused on what my goal is, what my intention is, because maybe polarizing. I want to stay charismatic, but I throw my arms up. You guys, I got hit hard. I mean, it's not that I'm like gun shy or maybe I'm in a little shell shock. I'm a little shell shocked because I see like the same pattern happening. I see the same math. I see the exact same lines, the exact same lies, deceit. And so, when I see his tornado come in, man, I yell and I scream. I lost my family. I don't talk about that a lot. I had another relationship before the one I'm in right now. And when I lost my job and my house and my confidence in myself, the pain that was caused for me losing the respect from, at that time, the person I was in a relationship with, and then that put stress on her, with our child, with my son Wyatt, that. Man, I don't know how I survived it. And I tell people I struggled for 9 years, Melody Jack, and that was really hard for me that 9 years. But I don't tell people how hard it was the first 3 years. The first 3 years, man. My God, you guys would never have even looked twice at who I am. I mean, I'm a completely different person now, but the level of depression and anxiety, these are real things. These aren't just words that I'm using. Is very heavy and is very crippling, and depression is very sticky. And I don't want anyone to be wrapped up in that. And I'm sorry if I get a little crazy about that, but my God, I don't want anyone to go through what I went through. And I think I got hit harder than you, Melody and Jack. I think I did. I'm not sure. But I mean, you guys, I had a bankruptcy, I had a foreclosure, I had a repo, and I had an IRS tax lien for over $100,000 that followed me around for 9 years. And I got that tax lien because of my foreclosure. There was a deficiency notice, meaning that the bank, when they foreclosed my house, they could not sell it for what I owed. So they hit me with something called a deficiency, and the deficiency was treated as income because the IRS, for some reason, did not allow me to file insolvency, which was something I was supposed to be able to do. My point is, you know what? If you want to spend your money, spend your money. We're just trying to give you reasons why not to, and what could potentially happen if you recklessly are spending, and keep your head in the sand. We're not right about everything. So I just want to Melody first, if I want to read this, Of course, brother, if you didn't go through the GFC, you should learn about it. We all get caught off guard. Our town died, 54% median sales price drop. Friends lost homes, divorces. He knew one person that committed suicide. If the market's built on emotion, I mean, how emotional does the market get when it's collapsing, Melody?
I mean, we're already seeing it. You know, there was a story about a guy in the Hamptons who just recently, unfortunately, committed suicide, and he owed like $17 million. And they titled, it was in the New York Post, and they titled the article, Keeping Up with the Bezoses. And, you know, guys, we're going to see more and more stories like that. Unfortunately, you're going to hear a lot more about suicides, depression, because people unfortunately tie so much of who they are into these things, into having things, owning things. And Travis, this is why I appreciate your story so much, is because, you know, you went through that and came to the understanding that those weren't the important things in life. And that was very much kind of, you know, part of you growing up and reaching manhood and coming to understand that that isn't what's important. Like, I didn't get hit like you did during the GFC, but later. And I had to, because I basically kept working like a crazy person trying to save my industry. And I have no idea why. But anyway, you know, I came to understand a lot of my choices made absolutely no sense, that I wasn't living a purpose driven life. And so,
That's a great
so,
book.
yeah, but, you know, can have that humility. And it's, you know, unfortunately, a lot of times we can't be born with that humility. We have to experience something really terrible to find it.
And honestly, Melody, the humility you're talking about, that's why and I apologize to the viewers, why I got a little spicy today, because I didn't see the humility, and I just want people to be careful. And I saw that person, I don't remember his name, but the guy that was in the comment section, it reminded me of myself when I was younger, because when I was younger, and Melody, I mean, I was in the industry. I was a loan officer and I was a realtor during the GFC, and I was known as Prodigy. I have a whole bunch of awards behind me of all these awards that I won, but I was so confident in my own ability to make money that I assumed that I understood what was going on in the economy, and therefore the advice that I was giving to my clients was horrible advice. And because of my overconfidence and lack of understanding, I think I may have hurt people. And it sucks, man. And I don't want like the people there in the comment section, or anyone that doesn't believe us, I just don't want you guys to lose. And I figured, you know what? If you hate me, I don't care. As long as you're not losing and you're winning, you can hate me, you can love me. You guys don't want to go through what I went through. No, I don't want anyone. I mean, because you don't have to. You don't have to. There's no reason to go for it. A slight changes in how we live our life and spend our money is all it usually takes. A slight change. But but I understand. I'm not so naive. I got wrapped up in it. I got wrapped up in my bubble, Melody. I was sold that bubble, that lifestyle. I was just a slave to debt. And I fooled. And honestly, Melody, you know what? I fooled myself. Myself. And that's the reality of the situation.
Well, that's
Jack,
usually who we fool first, right?
Yeah, it sucks. Jack?
Yeah, you know, this comment, Jimmy Dean, this beautifully illustrates, and beautifully, terribly, whatever the word you want to use to describe it, but this illustrates that scene from The Big Short, Just Don't Effing Dance, when Brad Pitt's character tells the guys, you know, they just locked in the trade, and then he says that one data point: for every 1% unemployment goes up, 40,000 people die. And there's debate about the accuracy of that comment, but there is plenty of science and studies to show that when unemployment rises, deaths of despair, right? People unaliving themselves, DUIs, car accidents, domestic abuse, all kinds of terrible things increase when unemployment rises. And, you know, for a guy like me, a doomer, a perma bear, when we see things like unemployment rising and market corrections, a lot of the times that means indication or vindication. And there's a tendency to get excited about that because you want to be proven right. But at the same time, it means more stories like this. So you got to kind of ground yourself and not get too excited when you see days like Monday, when there's just mayhem in markets, which, you know, the market is overdue for. You know, we need to get through that pain in order to come out of this on the other side. But that also means going through stories like this to get there. And when that happens, and this will happen again, and these stories will come back, it's sad, but that damage has already been done. And most of the people that this has been done to still don't realize it's been done to them yet. there's going to be a tendency for the people who caused this to say, you need to give us more power, lower interest rates, print more money, give us more emergency powers to stop this from happening. That's what causes this crap to begin with in the first place. So I think the key is financial education. And it's one of the things we're trying to accomplish with this channel is to educate people to spot that BS before it comes out in the market, so that the next time they promise us easy money as a way out of this, we recognize it for what it is, and the next robbery already starting. And hopefully people don't go along with it when that happens. But because they're going to try it, they're going to try to lower rates and print money again. They always do. And every time it's to their benefit and to our detriment. But when people are desperate, they'll take anything, any solution being offered by anyone. And the politicians and the financial elites know it. So don't let them get away with it next time.
Melody, I'm going to put you up there real quick because I want you to sing and shine and knock this out. This comment's made for you. The U.S. is failing its own citizens by not providing basic life education and allowing the justice system to be completely corrupt and trickle down to a local level. Can you just slice that up?
So I think that it goes to what Jack was just saying about financial education in this country. I mean, it's abysmal. People do not understand it. I was recently talking to a recent grad, and he was an economics major, and he had no understanding of how rates work. And so we don't prepare people for what's happening out there. And in many ways, that is to on purpose, because if people truly understood the debt slavery they were getting into, they wouldn't do it. But the powers that be need us to continue to spend. We're 70% of GDP. And so they are going to do everything in their power to try to get you to spend your very last dollar, even if it is to your complete and total detriment and destruction. And that's what we are doing here, guys. We're not trying to tell you what to think, how to think. We're just trying to give you tools to really debunk what you're hearing out there, because there is one goal of mainstream media, and that's to keeping you to keep spending, to keep the people in power that are there today. Travis.
All right, so I was muted. Really funny comment right there. I'm just gonna remove that real quick. Okay, so Jack, I want you to knock this one out if you can. I want to test Jack. This is a bit of a test for Jack, Melody, because he's not as much in the mortgage and mortgage and the housing market. So you are being judged. Okay, so Jack, if you can nail this one, this is from Lisa. Thank you for participating, Lisa. We hope we're giving you overwhelming value, at least allowing you to consider the possibilities of being cautious. Imagine what housing would look like if lending was solid versus made up data propped up by banks and mortgage companies. Do you have anything within your soul to say, Jack?
Soul? I don't have a soul. But what would housing look like if lending was solid? That's a little subjective there, versus made up data propped up by banks and mortgage companies. So if we were to, when we say lending is solid, let's assume that means none of the artificial players in the mortgage market. And by artificial players, I mean like the Feds. What do they have? $2.3 trillion worth of mortgage-backed securities on their balance sheet. It doesn't include treasury buybacks, artificially juking down long-term interest rates. It doesn't include the Fed's Operation Twist thing that they're doing, by buying more long-term debt. If we actually had mortgage lending based on the supply and demand of housing and the supply and demand of money, more importantly, I think interest rates for housing would be sharply, sharply higher, and thus home prices sharply, sharply lower. And then you also have to factor in things that we're doing that also artificially jack up home prices, like eviction moratoriums that are still in place in some places, the way they run the housing market in California, the way they're giving people money to go buy houses in California, laughably how like all that money is gobbled up in like hours. There's all these things the government does to artificially inflate home prices. If you take all that away, the price of cash would be much higher, interest rates would skyrocket, and home prices would fall. And we are in a Keynesian borderline modern monetary theory system here, where endless expansion of the money supply fuels endless growth of these asset prices, which fuels this massive gap between the haves and the have-nots in this country. And it's grown to obscene proportions right now. The only way this system can survive is by continuously bloating the money supply. The second you stop, it collapses like any other Ponzi scheme. The second the new money stops entering the system, it all just falls apart. So yeah, home prices closer to what we had in the 1980s, even the 1970s, if we actually had a solid lending and mortgage system, which probably won't happen. I'm not saying prices are going to go back there, because they're going to keep their fingers on the scale. They're going to keep messing with it, but that's what would happen.
All right, I got a couple more real quick though. Man, you guys, you have no idea. Like, you guys know I'm kind of a nut, but this is the guy. Me and him were going back and forth. I just want to say I'm proud of this guy. I'm proud of Chris because he stayed here. He learned. He allowed me to talk to him in a way. And I just want to tell you guys, everyone that's listening to me that thought I was being mean, I'm loving him. This is how I love. I pushed him against the wall. He stayed, and he had a conversation with someone else, and he grew. And thank God, because Chris, honestly, brother, in the back of my mind, I'm like, oh my God, I hope he doesn't think I'm being mean. But when you love someone, you've been through and this is just how I was raised, you push each other a little bit because you make each other stronger. It's called iron sharpens iron. So brother, I love you. I will be looking for you, Chris, on a wave. Chris on a wave is, thank you
This
for
is
being here, man.
Travis's street upbringing coming out.
No, I mean, it's important, man. I mean, men need to be men. Men need to step up. You want to know what's worse than the fraud and corruption and greed and the Fed? It's, and I'm not getting sexist here. It's a biblical thing. I just think it's a lack of men stepping up. And so when it comes to men, especially Melody, I think that should be hard. I'm a father. I have 2 sons.
I get that. I really do. Yeah.
All right.
Okay.
All right. Boom. Let's see here. I had one more. You guys get me emotional. Here's one right here. Didn't Henry Ford say, if the people really knew how the banking system worked, everyone would revolt? I want to give that to Melody, Jack. All right, because she just looks vicious. Just get him, Melody.
No, I kind of agree with that. And I think that, that's honestly, again, kind of like what you were saying, Travis, about the gray rhino, or just awareness is actually the biggest risk to our financial markets right now, because there's just so much effort being put into us to gaslighting us. And so, I just think it's really, I would agree with this comment. That's probably, we're not going to have 100% awareness. There's not enough people that have the time. They're too busy working, but we do have to make the choices we can make. We have to do the things that we can do. And honestly, I think coming together through the community, we're spreading awareness, and we're trying to teach people how to debunk these massive narratives. And honestly, so that we can change things for the better. And so, I agree that this is probably true, but I also know that likely that we won't have mass awareness. But we're doing everything that we can to tip the scales here.
Mute.
I guess. Anyway, all right. I need, just for sake of time, I need Jack on this one. Jack, and this is going to be a little bit of a different setup right here. I need you to explain. Okay, first of all, let me read this. Forever grateful for you three. Saved me from buying stupidly. Would have deepened my debt by $200,000. I'm old as the hills. Got very bad advice on all fronts except yours. First of all, I want to say thank you for putting that, but I want you to explain, Jack, how you can't trust anyone, and you have to be careful no matter who you're listening to, including us, because I want you to explain to the viewers, Jack. And again, I appreciate, lady, thank you for listening. But can you explain how dangerous it is, Jack, to let other people do the thinking for you? And I'm not knocking lady. I'm just letting the viewers know we understand how this whole thing works. And we're trying to be very careful on people remaining independent thinkers.
So I don't know the context of this situation here. Deepen my debt by $200,000. I'm not sure. I'm guessing that was a housing transaction there. I don't do advice. Don't have the piece of paper that allows it. But I'll tell you this, if you're wondering who you can trust and who you can't, the default answer should always be don't trust. And that's a very cynical approach, but we live in the golden age of fraud and it's everywhere. And I'm generally a very skeptical person to begin with. All right. I mean, I approach everybody with a certain arm's length and skepticism, and some have gotten past me in recent years So, even me who questions everything, it still gets by me. I would say the most important thing is ask yourself, anybody who is giving advice or presenting some situation on YouTube, even or on a channel, how does this person make money? Who's advertising on that channel? What are the links in the description to, are they selling a course? Are they selling, I don't know, like an affiliate link? All right. Like there were people out there that were pumping crypto that were saying, oh yeah, use my link down below, get $15 free on FTX or get $50 free on BlockFi. Right. I mean, they were leading people to the slaughter. And these are some of the biggest freaking names in YouTube that were doing this. And they all got away with it. They all still have massive followings and they're all still making money hand over fist, even though they led people to the slaughter. Ask yourself, how does this person make money and how might that influence what they're recommending? Are they recommending something that is directly aligned with their own financial interest? Well, then they don't have your interests in mind. And also, especially when it comes to finance YouTube, and this is very important because there are a lot of easy ways to make money in financial YouTube, but they're not necessarily ethical ways to make money in financial YouTube. All right. Because a good investment sells itself. So why would anybody be advertising in financial YouTube? If they were really selling a good investment, they wouldn't need to advertise. And so anybody who's taking money to push a financial product, that money that they're taking is coming out of the profit margin of the company that's selling it. And therefore, it's probably not a good investment for you. So be very skeptical of anything being sold on financial YouTube. If it was a good investment, you wouldn't need to sell it. It would sell itself, right? Good trades, by the time everybody finds out about it, it's too late because the people have already gotten in early. So just, always ask yourself, how does this person make their money? And then does that align with your interests or mine? That's the best advice I would say.
Okay. I'm not done with you, Melody. We're going to continue this because it's so important for content creators. If there's any influencers, Melody, we have to understand between each other as influencers, and we have to acknowledge, and the viewers need to understand this. There could be a period of time where people make mistakes. In other words, if we don't stay sharp, then people should stop listening to us. Is that correct, Melody?
If we don't stay sharp, people should not listen to us.
Let me just rephrase. If we don't stay sharp, I'm just going to say it like that. We need to stay sharp. There's a lot of crap going on here. In other words, you can't completely trust people. You can't, because there are seasons in life. And will you go into that?
Yeah. Well, yeah. So I think, again, guys, I think Jack said it very well. I mean, we're not actually trying to tell you to trust us. We're just trying to get you to ask questions, providing alternative facts to the ones that you're seeing out there, providing the math so that you can understand why what people are saying is not accurate. And so I think that's the difference here is we are just trying to provide the tools and we're not trying to tell you how to think.
It takes me back to that NAR ad from 2008 too, right? If you had approached that skepticism, how do these people make their money? Oh, that's right, real estate commissions. Well, now I understand why they're telling you it's such a good investment to buy a house in 2008, because their livelihood freaking depends on it.
That's right.
I like this one. I just wanted to add to this is if you're not making mistakes, you're doing nothing. We learn from our mistakes. So, but by that rationale, I should be the smartest of you three. So I think another thing we could do is we don't necessarily have to learn from our own mistakes, right? Like learn from other people's mistakes. It's harder. I get it, because you don't feel the pain, but my God, I mean, how many self-help books are there? I mean, literally everything is in the Bible if you want, but I think part of our growth is making the mistakes. I've been bankrupt. I think the most important thing about life is just learning from those mistakes. And I don't think we lose
learning. Yeah.
We don't lose necessarily if we make mistakes, so long as we're learning. When we start losing is if we don't learn, and we replace that learning process with ego, frustration, jealousy, right? Or being just things like that.
Can I add something to that too? We only learn from the mistakes that we pay for.
Mm-hmm.
All right. And like the financial elite in Wall Street, they never pay for their mistakes. We pay for their mistakes. So they never learn the lesson from their mistakes because they never pay for them, which is why they always repeat them. Something to keep in mind. Again, that trust issue.
All right, guys. I think that's, if anyone wants to throw any comments, go ahead. How do you guys feel? We're pretty much wrapping this up about 2.5 hours. You guys good?
Yeah, I feel good. How are you?
Yeah.
How am I?
Yeah.
I mean, I feel like I'm always in war, man. I feel like I'm always in war, man. I got 4 kids. Anyways,
I
it's
can
a
see
war
why
out
you feel
there.
like you're at war. 4 kids. Yeah.
And
So
over the
you had
last,
3, and then you're like, let's have another one. That's interesting.
we won't get into the
We know
baby
what
making
causes that
process.
these days, Travis.
Well, not everyone knows, Jack. Not everyone knows, brother. Melly, do you want
Right.
to take us out of here?
Sure, guys. Just want to say thank you again for joining us. Thank you for the support. Thank you for this active community that, engages throughout the show. We love it and we love hearing from you and we want to hear from you more. So please comment below. And if you have stories, bring those to us as well, because we're always looking for good stories and we want to give the community what it needs as well. So we need to hear from you. So thank you again for joining. Thank you for the support. We will definitely see you again next week. And until then, please always remember, math matters.